Hey everyone. Before we get into the interview, I just want to make a quick announcement that Ali's new Trade With Me program is officially live. It's a 10-month live trading program where you can watch Ali trade live every month. You'll be able to see his entries, see his exits, and watch him manage trades in real time. You'll also get a new educational module every month for 10 months. If this is something that interests you, you can click the link in the description and it'll take you to this page and it'll show you everything you need to know about the Trade With Me program. It'll walk you through the curriculum of what's going to be covered every month for 10 months, and it's going to show you all the principles that you're going to learn throughout the process. It also has a list of all the bonus material that you'll get for free by joining the full TWM program. So if this is something that interests you, make sure you click the link in the description. Hi everyone, I'm Faisal. Today I'm here with Ali-Moin Afshari. It's been 2 years since our last interview. That interview with him actually changed the trajectory of my trading life, my life in general. When you do something for so long with no success, it feels like there's no answers out there, but I finally found my answer, and I think a lot of people did as well. So I'm really excited to speak to you again today. It's really exciting to be here again.
Thanks, Faisal. Thanks for coming.
So Ali offered his home for our interview this time around. We've been planning it for a while, so I'm really looking forward to it. I think it's going to be really, really useful. We're going to go deep into some trading topics. So the first main topic we're going to talk about is Ali's experience as a professional trading mentor and what he's noticed that's missing in the education space for trading. Then we're going to talk about trader development. So what do traders need to do to get better at this craft and to really master it to become professionals? And then finally, we're going to go through some charts. We're going to talk about trading concepts. We're going to talk about breakouts specifically. There was a chart or a flow chart that Ali posted in the first interview to how to make decisions more effectively. So we're going to go through breakouts in different contexts and talk through the flow chart about how to think about this systematically and make good decisions when you're trading breakouts. So if you're ready to get started.
Yeah.
So just really good to be here.
Thank you.
When I first read your article 2.5 years ago, I was inspired to, that's actually what inspired me to start the podcast, is I wanted to talk to you. So I needed a reason to do that. And it changed everything for me. It changed everything for a lot of people. And I knew that that's the type of thinker I wanted to be. That's the type of trader I wanted to be. But getting to know you over the last 2 years, I realized that you're the type of person that I think people should emulate. You're a really, really good and caring person. And
Thank you, Faisal. That's very kind of you. I really appreciate that. I'll be happy to help as much as I can.
Yeah, I think that is the first thing that stood out for me is when we were starting up PTM, and I know there was a certain amount of people that I needed to make it worth your time. Mm-hmm. And I came to you and I said, like, Ali, I can't find, like, it's just really hard for me to find other people. And you said, it's okay, I just want to help. And that's when I realized that I found the right mentor.
Thank you.
And above and beyond that, I think what stood out to me after getting to know you is just how professional you are in everything you do. You're talking about the thermodynamics of toast when we're eating breakfast. You finished your basement on your own. You do the plumbing, you do the woodworking, and everything is just done so meticulously. And it seems like everything you touch, you hold to such a high standard. And I wanted to ask you, where does that standard come from? Is that something that you've worked on over the years, or is it something that's just something that you just do naturally?
Actually, to be honest with you, as a child, when I was doing my homework and I had to just copy everything in my notebook from the textbook, I missed things and it was all wrong. So my dad was like flabbergasted, like, you can't even copy from your textbook. But, over time, I think it's a feedback thing that you go through different projects, different things in your life, and you see that every time that you didn't pay attention to something, that thing came back and bite you or had consequences. So over time, that gets developed into the skill of paying attention to details. But I think in my line of work, I mean, not trading, but previous profession, which was IT, it really instills in you how important the details are. Because, for example, when I was doing consulting for telecom companies, we had a very limited implementation window that ran from, let's say, 10, 11 p.m. to 5 o'clock in the morning. And everything had to be back to normal at 6 o'clock. So it's like, to give you an example, it's like robbing a bank. Everything is on the clock. Mm-hmm. You know that the cops are going to be back at a certain time, and you have to have finished or you have to leave. And that makes planning so much important. So you know from your planning stage whether you can finish on time or not. And then you try to build a lot of plan Bs and plan Cs into it. So if the first plan A for the implementation fails, there are backup plans that will come and rescue the implementation session. And if none of them work, you also have a rollback plan, like, put things back to the original state you found them, and then come back and do it tomorrow night. So when you do that for decades, basically, then you start thinking like that with respect to almost everything. Even simple things like driving your car, you try to see hundreds of meters ahead of yourself. You're basically driving your car outside of the car. You're ahead of the car as you're driving it. So that becomes ingrained in you as, part of a character, I think. Then it's hard for other people because they can live with you because you want to plan everything, and
Yeah.
they want to be just in the moment and do things. And then you have to stop everyone. Let's think about this a little bit more. Yeah.
Right. Yeah. You mentioned in the past the driving the car example, and how, like, if you didn't want to have a single stain on your car, how would you drive? You didn't want to. You would avoid every pothole. You plan for every pothole. You plan for every puddle to make sure that nothing splashed on your car. That's the way you think about everything, it seems.
I took a number of flight lessons, and the very first thing the instructor tells you when you approach the plane, when you're not even haven't stepped into the plane, they tell you, listen, if anything touches this plane, you're dead. So make sure nothing touches your plane.
Right.
So that is aviation, but then you can take that example and use it in all aspects of life. Trading is like that too.
Yeah, and it does seem that you've taken that philosophy to trading as well.
Yeah.
Planning for contingencies. If something doesn't work out the way you had planned, how do you get out of the trade if it's not looking like it's supposed to? Your calibrated expectations.
Yeah.
So speaking of trading, now we're getting into the details of it. Your experience as a professional trading mentor, you've taken traders from hobbyists and struggling traders and turned them into professionals, and quite a few.
Yeah.
And I've spoken to them personally, and they credit you to their success.
Thank
and I think
you.
a lot of people appreciate that mentorship. But in your experience as a professional trading mentor, you've seen people come in with different types of experiences in education, like what courses they took and how they studied. And what have you noticed that is missing in the education space? Like, why are they still struggling after so many years?
Yeah.
What have you noticed?
Well, if you look at the like a university program, what does a university program provide to the student? Well, it has a limited time, so things have to be finished at a certain period of time. There are deadlines to things. There is a structure to everything. Although at the university level, you're really free to study however you want. Still, you have to study something, and that something is provided to you. Then there is guidance and mentorship. So you have a professor, you can go meet them, you can ask your questions. And then there's a community, you have your classmates. So there's also peer pressure. You look at other people and say, hey, these guys are really studying hard. Maybe I have to spend more time in the library, for instance. The environment is conducive to success. Now compare that to somebody who is training for trading on their own. Well, they don't probably, especially if you're using an online program, they don't have a mentor. So there is nobody to ask their questions. More importantly, there is no deadline. Like it's up to you to finish. So you can procrastinate and there's no consequences to that. And then there's no peer pressure either. So all of those things, plus the fact that there is like no external reference point for people, all come together to undermine their success. Now, we provide all of that in Systems Academy 2 program, for example. There's a mentor, there's a group of people there's a cohort of people who start at the same time, so they see each other's work. There is a finite deadline for their projects. And then there's oversight. The mentor or the coach is overseeing the project development. And there's homework, so they have to do a project. So we're giving them all the elements that are missing in, self-study for trading.
Right. Yeah. And that's what we see in obviously PTM and Systems Academy. It's so structured. It's been laid out so thoughtfully to enhance the education of students. And so you have this course on discretionary trading, the course on systems building, and now you're in the process of building a new course that is hoping to put everything together. Can you talk a bit about that and the motivations to create it?
Yeah, sure. So the last two times that Dr. Brooks and I did a live conference, like a seminar, part of the like more than half of the time in that conference was devoted to live trading. And at the end of the conference, a lot of people approached me and asked for a possibility of having the same experience. They said, you know what, we learned so much in the past 2 days that you were live trading, you and Al were live trading, and we want to have more of that. And I was thinking, okay, so if I want to do that, I have to start a trading room. I don't want to start a trading room because that will ruin my trading day. I trade for myself in the mornings, as you know. So, what is the best or most effective way of providing that experience so that it's not an open ended trading room that you have to attend forever and hope to get something out of it? So, the same thinking, you plan for details, you plan it in detail and try to implement it correctly. That takes a lot of thought and work before you can launch any program. But the idea is there's a syllabus for training, for live trading training, and starts from very basic concepts and goes all the way to advanced limit order trading. We are going to break it down into 10 sections. Each section is devoted to just one topic or one or a few topics that are very closely related to one another. And we're going to provide the training for that one module in the form of a video course. Brad and James are currently working on recording the videos. I wrote the program, so I provide the content and they are building the videos. So the student will watch those videos initially, and then we're going to have a live trading session. In that live trading session, hopefully the market's going to cooperate and give us the things, the setups that we have just taught in that video course. And I will be trading them live and talking about my analysis and, the mental process of getting to a trade management and everything. And the session is also supported by Brad and James. Like our coaching team is all going to be there, followed by a session for questions and answers. So this is going to be one trading day every month. And the idea for having one trading day and not trade all the days in the month is that if you want to develop a habit, you have to do it about 20 times. We have 21 trading days a month, approximately. So we're going to take one of those days for live trading to show you how to implement the ideas that we just presented in the videos. And then you have 20 sessions to practice that one thing on your own. Then come back next month. You're going to be trained for the next module, which is a different concept. And then we're going to use one day to show the implementation of that one concept. And then you have another 20 days to practice that concept, followed by an opportunity to ask your questions. So that's the idea, to take a trader who wants to develop skills through a structured series of training sessions, followed by actual implementation, followed by your own practice, and then an opportunity to ask your questions.
Yeah. So there's going to be an educational component, and then they're going to be able to see it live execution. You're going to be trading live, and you're going to be trading that concept, hopefully. And then they're going to be able to practice it on their own. I think being able to watch you trade is, wanting to watch a professional trader was the only thing I wanted when I was
me too.
learning. Yeah. It's all you want. And to your point, I think there's a lack of structure in education for trading, at least before I met you and we connected in this way. It was really hard to find structure. But most of all, I realized that I was learning by finding out all the wrong answers. I was just trading and realizing, okay, that doesn't work. So I put in a basket of wrong answers, and I was just left with a really big basket of wrong answers. And I just wanted a basket of right answers. And I wanted to ask someone, I wanted a mentor to ask my questions to and ask them why they did something. And the fact that you're creating this now, a little bit late for me, but yeah, it's exactly what I would have wanted. I think it's going to help a lot of people.
Yeah, that's correct. I mean, one of the misconceptions with education for trading, and you see it all the time online, you see it, you hear it from everyone. They tell you have to have a screen time. But screen time is not going to do anything, because screen time means you're sitting there and discovering the market behavior on your own. It's like building the wheel again for yourself. That is a very inefficient way of using your time. It's much better to know exactly what to look for and then have your screen time. Then sit and look at the charts and see, okay, so I know this concept. How does it play out in different days, in different market periods? Then that is useful, screen time. You're going to learn something from it. But if you just sit there and watch the chart every day, bars go up and down, that's going to be very inefficient.
And just to clarify, by the time that this interview is posted, there will be a link to join TWM. It's a program. It's called Trade With Me, and you will have access to that. So make sure you check out the link in the description. Okay, so now that we're in the depths of trading, I want to talk about trader development. So how does someone actually get better at this? And I think the first broad topic that really resonated with me was when you said that trading is like an ocean that is vast but not deep. Can you talk a bit about what that means to you?
Yeah, so if I explain any trading concept to you, that one concept is actually a very simple concept. Like, you can explain it to a child in 10 minutes, and they're going to know it. But then how many of those simple concepts do we have in trading? The tons of them. So learning each one concept is not going to take all that much time, but learning the entirety of it takes a fair bit of time. But then beyond that, you have to be able to connect these things together. So the inner connections of how these concepts connect to one another is as important. And if you multiply the number of concepts by the number of possible connections that they can have to one another, it's going to be huge. And then you have multiple connections. And then on top of that, you have multiple time frames. And one time frame is operating based on one concept at this time, and the lower or higher time frame is doing the exact opposite. How do you reconcile that? And that creates that ocean. So the ocean is not deep, but it's vast.
So it's the interconnectedness of many shallow concepts they have to keep in mind at one time.
Yeah.
And yeah, that is what I found is that you know one concept, you know it deeply, but how well can you execute that while thinking of 50 other things at the same time? And that is the challenge. I
have a video on our YouTube channel that I cut from a section of a PTM session. So I talk about this. I call it traders' imagination. So traders have imagination in their own way. So they see multiple time frames at the same time in their mind. In addition to the time frame they're looking at, let's say somebody's watching the 5-minute chart. At the same time, in their mind, they know what this time frame is doing to the higher time frame, which is like hourly chart or daily chart. What daily chart is doing to the weekly chart, what weekly chart is doing to the monthly chart, and at the same time, how's the lower time frame looking like without actually looking at that chart, like a minute chart or so. And they see all of this as a continuum, not as separate things. So there are certain expectations for example, support and resistance, simplest concept in trading. We have seen, if you look at any 5-minute chart, most of them have a very sharp move in the beginning of the day, first 1 or 2 hours, and then it fails most of the time as well. So why is that move there? Why is it that big? Why is it reversing at that price? So a good trader has expectations for all of those things, and this is based on their imagination. So the same ocean, like everything is connected together, but then they see all of that connectedness in one place. So they don't have to flip back and forth between the charts. A trader has an idea of what the charts look like even without looking at them.
Mm.
And that is because of the experience and the neural network that's being built after so many years of studying and trading.
Right. And that trader's imagination that's built over time, I think time is something that many people who love trading will put into it.
Mm-hmm.
But it's the next step of that is, what do you do with that time? And so how are you spending that time studying?
Yeah.
And that's really what I want to get your take on here is, if someone is passionate and willing to improve at this and they have 2 to 3 hours a day, what should they be doing? It feels overwhelming that there's so many things they could be doing with their time. What would you recommend that someone do with that free time if they're really, really passionate and they want to take this as a career and make this a career?
I think the first thing is to be realistic, to know exactly what are your resources that are available to trading. One of them is time, but you also need other resources. Like, for example, is the family on site with this activity? Are they going to support you? Do you have the environment that's necessary for studying? Do you have a room to be quiet there and, isolated from everything else that's going on? Is the capital available to you to trade? So all of the resources should be there to support you. But beyond that, just focusing on time. Let's say somebody has 3 hours a day to devote to trading. That 3 hours must be uninterrupted, in my opinion. It's a period of time that you're isolated. It's like you're at work and nobody is allowed to come and interrupt you. And then you have to have a plan for the time that you're going to be devoting to trading. And the way to plan for it is usually to plan from the end result to now. So, for example, we want to become a breakout trader. So that's just one concept. It's a big concept, but it's just one concept. So you consider the end stage and move back from there to now and structure your time, setting objectives along the way, milestones that you have to achieve, and then give yourself time to achieve each one of them. When, in addition to that, you also have to be realistic with the amount of time that you're giving to each one of those objectives. And usually, whatever time, at least initially, seems to be reasonable, is usually not enough. So you have to, sort of like factor in additional time, allowing yourself to go over time to get to those objectives. Obviously, you can stop and reconsider your planning and change things if you like. But in my experience, learning to trade takes much longer than people expect it to take. So budget 2 to 3 times more.
Hmm. And so with that time, let's say you want to be a breakout trader, you often talk about focusing on 2 major things: market behavior and first principles.
Yep.
Can you talk about what that means to you? What should traders focus on if they're focusing on market behavior and first principles?
Right. So I guess it's worth mentioning what is the difference between price action and market behavior. Because market behavior ultimately can be explained by price action. The way I see it is that price action is more local and more in the now, but market behavior is more general and deeper. For example, the first principles of market behavior that you just mentioned, they are more closely related as a foundational concept that's overarching everything. And the result of their interplay with one another, different market principles, first principles of trading, how they interplay with one another creates the price action that we see on the charts. So price action is definitely how we see the market behavior, but to me at least, understanding market behavior is a deeper level of understanding. So you, for example, begin to understand why things happen in a certain way that they do happen. What are those deep, concepts that create the behavior that is ultimately seen as price moving and creating the bars and the relationships which we call price action?
Right. To you, what are the first principles?
Well, there are quite a few of them, and we're going to talk about each one in Trade With Me in TWM. In fact, the syllabus for TWM is structured around market behavior. So we're going to look at each one of those principles in one of the modules of the TWM program. But to give you an example, just for the price to move from one number to another, from one point to the other, is a market principle. It's the principle of breakouts. Like, this is what markets do. Markets move the price from what you see right now to some price in the future that can be higher or lower. And in doing so, they create breakouts. So that's one of the basic, like most fundamental concepts of market behavior. And it's simple to say, okay, price moves from point A to point B and you have a breakout. And what's difficult about that? The easiest thing that I can say is price moves from one number to the other and you have a breakout. But once we delve deep into this, you're going to see that breakouts are actually not that simple. And there is a lot of detail associated with them. And I think it's the most important principle in market behavior that any trader has to master first. There's a very big emphasis in understanding breakouts in the way that I teach people, because I think that when they understand breakouts, then everything else will become a lot easier. Like, why should they fade a breakout? Every time you place a limit order, you're fading a breakout, you're going against the breakout. So why would you do that? Why would you ever do that? So understanding breakouts as a core market principle allows the trader to understand everything else much better, like reversals, trading in trading ranges, range compression, all those things that are actually against the breakout behavior could be understood much, much, much easier and deeper. And that allows the trader to be a lot more flexible, to be able to trade with limit orders that most people are actually afraid of doing.
Just to set the expectations of how much work it takes and how much practice it takes, you often say that it takes 1,000 charts to understand a concept. Is that from your own experience, and what have you seen in your students?
Yeah, right. So 1,000 charts is about 4 years of trading, because every year we have about 252 trading days. So 4 years is about 1,000 charts. There are two reasons that I ask everyone to at least analyze 1,000 charts. The first reason is repetition, obviously. So the number of opportunities they get to look at the same concept, that seems to be a good number, 1,000 charts. Because the market has different variations of the same concept, same theme, and you need to have that repetition. You need to see the same concept play out in different forms, different shape of patterns, and in different market environments. Like, for example, you can have a very high volatility environment in a crash situation. You can have a very low volatility environment. For example, look at charts from 2014, 2013. The market was in a small pullback bull trend on the daily chart. So it was not moving all that much, was not pulling back all that much. Volatility was very low. You still would get wedges and breakouts and everything, but then the patterns are smaller. So you have to see that. Also, these patterns are responses to the previous market behavior. And because there's a range of behavior, the response is also going to be in a range. And the same response could be given to different market events. So you have to see all of those events, or like a good basket of different varieties of them. And then you have to have this other big sample size of all the different kinds of responses the market gave to that specific, setup or market event. And in the mix of all of that, then you have seen enough to have formed a good experience, or a good sort of like a mental database of how these things correlate to one another. But looking at it is not enough. You have to understand the concepts and understand the relationships between them. So when you look at the charts are meaningful. If that part is missing and you just want the screen time, it will get boring very quickly, and you don't want that. The second reason is especially if you're trading US markets. US markets go through presidential cycles, and each US election is 4 years apart. So by studying a 4-year period in the market, you have seen every single year in a presidential cycle. This is not really important for a day trader, but as a day trader, you also have to train yourself on higher time frames. You have to know what the day session, daily chart, and weekly chart and monthly charts are doing, so that you have certain expectations for the kind of day that you're going to be seeing today coming into the market, which we call top-down analysis. So to go through your top-down analysis every day, you need that 4-year exposure, because then you will see the effects of the US presidential cycle on market behavior. You have at least seen one election night and the volatility it causes. You have seen the pre-election campaigns, the effects on the markets, and you see when the results come out and you know who the new president is, how the market reacts to it. Then every new president brings on certain policies, and those policies sometimes increase or decrease volatility in the market. You want to see all of those things. And that's why 1,000 charts is necessary, because it at least gives you the higher time frame exposure to one complete presidential cycle. Now, if you really want to be thorough, you actually have to do two 4-year periods. And the reason I say that is because sometimes the president is reelected, and the next term, the effect of the same president on the market for the second term is different from the first one. So if you want to be really thorough, you have to go through 8 years of past, market behavior and cross-reference it to the political environment and what was going on. And that will give you a really good understanding of how the political cycle affects market behavior on hard time frames. And then if you also study the lower time frame, which means the execution chart for a day trader especially, then that's going to give you a lot of good experience. But the important thing here is the continuity of it. Okay, because you can look at 1,000 intraday charts, that's one thing, fine. But that's not what I'm talking about. You have to look at 1,000 intraday charts anyways. The important thing is cross-referencing it with higher time frames and cross-referencing the higher time frame with what's going on in the society in that period of time. Sometimes it's actually difficult to find the information, because you look at historical charts, the chart is easy to get, you just get it from your trading platform, for example. But the important thing is to also understand what was going on in the society that created that chart. And that is important. I think that plays well into a trader becoming well-rounded and an independent thinker, because ultimately all that we do as educators or for others as students is that we want to create independent thinkers in our students. Like somebody who comes to me, don't want to have them forever. I want to train them and then hopefully see them that they become completely independent of me. And part of that independence comes from being able to think holistically and correlate different things that are going on. Part of it is the US election cycle.
Awesome. Yeah, I think one thing that you mentioned when you talked about mental database, one thing that made a difference for me was when you also said to have an actual database and to look at a concept and to see all the ways that it succeeds and all the way that it fails, and that it fails with different behavior. So if you categorize those things, you have an idea of, oh, it's doing this thing now. It's doing this thing now. And you just get so comfortable with it. And I thought 1,000 charts was way too many. But then when I obviously going through PTM and systems, you really start to it feels like second nature. That one concept just feels like you know every possible variation of it.
Yeah.
And I think that's what made it so important for me. You mentioned that a lot of people underestimate how long it's going to take to become a professional trader. There was a slide that you showed me that in a presentation about expectations for proficiency. Can you share that? I feel like it gives people a really good understanding of what to expect on this journey.
Yeah, definitely. So this is that slide. And this is a slide that I use when I'm talking to SA2 candidates, Systems Academy candidates, because people don't realize the amount of time that's necessary to become a trader, really. But this is actually true with respect to almost everything. And especially any business that you're going to set up also follows the same sort of curve. Here we have the skill level, and on the bottom we have time. On the skill level vector, there are two markings: skill level to achieve excellence and the minimum skill level necessary to achieve positive cash flow from trading. This is typically where people say, all right, if I make this much money from trading, I can fire my boss and become independent. That's usually the first goalpost for most traders.
Right.
Now, the expectation that most people have is that here's my first target, and I'm going to be really diligent and really devoted to learning. So I'm going to put in my hours, and the expectation is that we're going to reach this point in a certain amount of time in a linear fashion. Like I put, let's say, 3 hours of study time to learn a concept and be able to implement it. That's not the case. Usually what takes place is, at the beginning at least, the growth is a lot slower. You're still learning, but the learning is sort of not visible to yourself. Like when you think about, okay, can I implement that? No. Can I implement this? No. But in reality, things are happening. It's just that the neural networks that's necessary to be built in your mind is being built one piece at a time. So you have to build it, and then you have to have inner connections as well. All of those things take time to form. So at the beginning, the feeling is like there's no progress, but there is progress. It's just that you don't see it yet. Things are happening behind the scenes, so to speak. So typically, most people take a lot longer to get to the first target. And that time, in my experience, is more than 2.5 to about 3 times their initial estimate. So if you think you're going to be independent trader in, let's say, a year, that's going to be 2.5 to 3 years. But you're going to get there if you keep pushing and don't lose, your steam, so to speak. If you keep doing what you've been doing, and I just want to digress for a second here. A lot of students that I see, they have very high motivation at the beginning. So they're really devoted at the beginning. But the estimate is, okay, I'm going to get there in a certain period of time. No, that's not going to happen. So that becomes a disappointment. They lose that energy, and the energy just fizzles out. And then they wouldn't even get to their targets, not even to the first target. So it's best to look at this as a marathon, that you have to preserve your resources for the long run so that you can stay in the game long enough to actually build the experience and the skill sets that's necessary to even get to the first target, which is financial independence.
Yeah, I think that's why this chart is so impactful, is because understanding your expectations, you're able to manage that disappointment. That if you think that you're going to get there in a year or 2 years and you're so excited about it, when you finally get to that 2-year mark and you don't feel close, it feels like I'm just not going to happen for me. But when you see this chart and you realize that you're still in that flat portion of that parabolic chart, and at some point it's going to hockey stick upwards, it gives you confidence to temper your expectations a little bit and give yourself time.
Yep. In my case, years ago, there was one day that my wife asked me, okay, so when do you think you're going to be trading the way that you want, at least? And I said, well, I don't know. It's like asking somebody who's studying art to become an artist, when are you going to have your big exhibition and sell, pieces of art for thousands of dollars? The guy's going to probably throw his shoulders and say, well, I don't know. I'm just doing what I can, but I don't know when that day is going to come. And that was my answer to her. But she was very supportive of me. So she said, okay, fine. So at least she was seeing that I'm putting in all my time. So there was no slacking on my part. But I was going through this period and it was taking longer than everybody expected, including myself. But this is the reality. This is what I've been seeing for a lot of people. So by the time you get to your first target, usually, like if you compare the linear line with the parabolic line, people think they're going to get to the first target here, and it's going to take them longer than this period, this first period of time, to get to the second target. But in reality, it's the reverse. It's going to take a lot longer to get to the first target. But once you get to the first target, it's going to take you a very short period of time to get to the second target. Because at that point, there's so much skill and experience already built in to allow the trader to trade independently. Like the financial problem goes away.
Right.
That in itself is a huge relief. Like, when you know that you're not dependent on a job for your lifestyle, you're much more relaxed. So that in itself is going to contribute to your accelerated, performance. Your learning is going to speed up a lot more because it's like building success on success rather than building something towards success that's not yet been seen or experienced.
Right. And then at that point, so that first target you're talking about is financial independence, firing your boss. The second target you're talking about is wealth, or quote unquote becoming rich and making a lot of money.
Yeah.
And once you reach that first target, what you're saying is that you've removed the financial burden, so the stress, but then also you have the skill set to make money consistently. So now it's more about scaling, less about learning. You're still learning, of course.
Yeah.
But now you've reached that one point where you have that widget that makes money.
Exactly.
And now it's about scaling.
Yeah, that's correct. I mean, years and years ago, I was at just above that point. So I was trading at home, was very happy. Things were going on quite well. And I sent a performance graph of my trading for a month to Dr. Brooks, and asked him, Al, what do you think? And I also sent him some information on my trades. And he said, well, this is very good, but 4 years from now, it's going to be completely different. So this is actually what he was implying, that your level of understanding and experience of your own trading is going to be completely different after 3 to 4 years from the point that you're completely satisfied with your trading.
Mm-hmm.
And I was reading his email and thinking, this doesn't make sense. I'm doing okay. So
Yes.
What can change? But he was right. And things can change. Things will change because your level of understanding becomes a lot deeper. Your trader's imagination is going to be so much bigger. So you would remember things that happened in the past that if you talk to other people, they're going to be astonished. Like, how do you remember, 3 months ago at 10 o'clock, what happened? But you remember that. And it becomes effortless. That's part of that expanded, trader's imagination and the function of your experience as a trader. And that will allow you to operate at a completely different level. And scaling up actually becomes easier at that point because it's going to be no pressure. The pressure is usually there up to the point that people reach their first target, which is financial independence. Once that is achieved, you're building success on success. Scaling up becomes easier. There's usually a lot less stress, or there's no stress. So things start to progress a lot smoother. So getting to the next target, which is like, I'm going to give a stupid, financial example. Like, for example, I want to buy a boat, and a good boat is $500,000 and up. It becomes easy to buy a boat, let's say.
Right.
But, to get to the inflection point that you can substitute your income with your trading, I think that is the most challenging period in a trader's development path, to get to that point, and then to see in themselves that, okay, I'm ready to jump ship, so to speak, ditch the job and switch to full-time trading. But once that is done, especially if you switch to full-time trading and you have a number of months under your belt already, like 4 or 5 months, and you're consistent and you're producing what you have been set out to do, then it becomes a lot easier to scale up from there than to get to that point in the first place. That's why this curve looks like this. It takes a lot longer to get to first target. It gets a lot shorter to get to the next target. And at some point, you're going to even exceed the expectations that the linear development had. It's multifaceted. Like for me, for example, I was also programming for my trading. And I had projects in mind that I thought it would not be possible to turn them into code. And it became possible. But to give you an example, the most extreme case was a project I was thinking about for about 4 years. And throughout that period, thinking about it every day, there was no solution. Not at all. Like there was nothing coming to mind on how to solve this problem. But then one day you say, so what if we try this? And then this is correct. So from a coding point of view, the assumptions that I had for programming, they also changed. Like, at the beginning, there's a lot of trial and error. Like, let's try this, let's try that, turn them into code to see if the code works. In the later stages, it's like, I know that it's one of these three things. It's either A, B, or C. And usually your first guess is the right one. So that's the level of, experience and knowledge that contributes to having a well balance of understanding for everything. And this is in every field. In every field, you have to know enough about it to be able to ask good questions. Because initially, if you're just brand new to something, you don't even know what questions to ask. So being able to ask good questions needs a level of understanding that's not at the beginner level. The beginner level, you're just receiving. You have to listen to someone or read books. You cannot think on your own. But at probably advanced intermediate level, you can start to think on your own and then be able to ask good questions. And then at an expert level, you still have the questions, but you can also come up with a short list of possible answers. And usually the first one is the correct one. And that's the change that happens. And this goes across the board with everything. It's just not just trading. Every field, to be able to ask questions, and intelligent ones, means you already know something about that field.
That's a really good point. Yeah, that's a good way to put it. In our first interview, you mentioned how coding is a really good way to understand price action. You mentioned it right now as well. I went on that journey as well a little bit to try to understand what you meant. And I really do know what that means now, that to tell a computer what to do, you really have to. So just like you said, experience allows you to ask better questions. Experience allows you to communicate. You can only communicate that to a computer if you have a certain level of understanding.
Correct.
With depth.
Yeah.
And so it really does enhance your understanding. And another thing you said in our first interview is that being systematic is the best way to become discretionary. That I didn't really realize how important that statement would be for me until I went through Systems Academy. I just couldn't get it before systems. I just couldn't find my way. And that stuck with me, that thing you said in that first interview. And I want you to talk about it a little bit now, because I know there's people like me out there who at that point had been doing it for 6 years,
right,
and I just couldn't find my way. And then talking to you changed everything. So I know there's someone else out there who's been doing it for a long time, and they're looking for their answer. They're doing all the work. They're going through all the material, trading every day, still not happening. Can you talk about that concept, that starting with a rule-based set is the way to become discretionary?
Yeah, sure. The problem with discretionary trading is that you try to do everything at the same time, and you still don't know enough about everything, and you don't know everything to be able to have that holistic view. So it's sort of like trying to create something that is very complex without actually knowing much about it. Trading discretionarily means that you can adjust to the market in front of you very, very closely. So there are no rules, basically. The rules are high-level guidelines. Like, for example, there's a breakout, try to trade in the direction of the breakout and try to cash the second leg. Okay, so that everybody knows that. But that's too general. How do you customize it to this chart today, right now, this moment that's in front of you? How do you do that? That's the hard part, because then all the nuances come into play, all the little things that are exceptions have to be accounted for. At that level, people don't know what the exceptions are, how to deal with them. So it's really important to just focus on one topic at the time and try to just understand that one topic to the most, to the like finest detail possible, and turn it into a system. When you turn it into a system, doing the research work that's necessary to build the system will tell you all the pitfalls. Like, it will quickly show you the failures because you're tallying your wins and losses. All of those losses are failures. So it will focus your attention to really develop that one concept in enough detail that is now a dependable trading system. Dependable means you can risk money on it without having concern for losing your account. But what it also does is the same thing that we talked about at the beginning of this conversation. How do you plan for everything? How do you pay attention to detail? Developing a system forces the trader to pay close attention to all the details and then to plan for all the issues that comes as the trade starts. It's typically easy to start a trade. You just put in an order and it's filled and you have a position open. But then what? Now the position open. Would you take the profit right now? Like, let's say you have a 2-point profit in S&P. Would you take the profit right now, or would you let it run a little bit more? Or sometimes you have a big profit. Would you take the big profit or add to the position? So all of those trade management questions are also important now, because trade management is built into a trading system. It's one of the modules of a trading system. You have to research each one of those actions as though it was just its own system and it was just a different system. But that system is now just one of the rules in your trade management package, so to speak. So that cycle of coming up with ideas for each part of the system, going back through historical charts to test it completely, that focuses the attention of the trader on just one concept. And you can imagine how many times you have to go back to your charts that you reviewed for your entry to now decide on exits or trade management. So it will really channel your energy in one direction and one direction only, in a structured way. And the structure is the core concept of that trading system, which is usually one of the basic, market behavior concepts. One of the first principles of market behavior that's usually at the core of a system. So you become an expert in that first principle, and your expertise is now also documented, because you have a system, you have to document it. So everything is nicely come together to produce a strategy that is positive expectancy, which means if you trade it over time in hundreds or thousands of trading cycles, at the end of the cycle, we're going to be cash flow positive. But in the process of building it, because of all those times that you have to go back and research each little piece of it, that also builds that database and neural network of nuances and interconnectivity of these concepts to the chart and to higher and lower timeframes, which is ultimately what you need to become a fully discretionary trader. Now, if you develop 3, 4, 5 systems, it's very likely that towards the later systems, you wouldn't need any of those systems, because you have researched the market so many times for all of these different concepts from different viewpoints, that you have already built that neural network and you have that experience under your belt now. And that's very common. Like we have past students from Systems Academy that tell me we don't need our systems anymore. But I look at their path of development and compare it to my development, and I see that because of that paradigm of working through a system, they managed to get to that point in half the time that I was able to get to, which is extremely valuable. If you can save half of somebody's time to get to a target, what bigger contribution could you give someone? You just save a portion of their life for them, which is it's priceless. Like you cannot buy it back.
Right. Yeah, I think the really big thing I struggle with is, and to your point, that to think through everything beforehand and to study the concepts so deeply that you know exactly what you do in every situation. I didn't know that was a path forward. I didn't know about systematic trading. I thought that discretionary was the gold standard and that's what I was supposed to do. And I just realized that I wasn't really good at thinking on the fly. I couldn't make decisions on the fly. And then you taught me, you don't have to think on the fly. You think on the ground. When you're not at the computer, you make all your decisions. How do you maximize profit if it goes in your direction? How do you mitigate losses if it's going against you? All those decisions are done beforehand. And then when you're at the computer, you're just executing. And that's what I needed. I just didn't know that's what I needed. And so when I started to do it that way, I'm not exactly where I want to be, but it just accelerated the growth by 3 or 4 years for me by going through your process. So if someone has an idea and they want to, they're inspired by this, they want to start a system, what are some initial steps they can take to start that for themselves?
Well, first of all, you have to know what you have to do to build a system. I'll give you an example from Systems Academy program. In SA2, what we initially provide is the minimum amount of training necessary to get somebody to understand systematic thinking. So we have to be able to think systematically for your training. There's a way of doing it, as you know. There are certain steps that you have to know, and you have to know how to do each step. And it gives you basically a flow chart of everything that you have to do proper research and be able to then put a system together. So you have to know that. If you don't know that, the best places to start is to study how trading systems are being developed. But to sum it up, it usually starts with a trading idea. And the closer that trading idea is to one of those 10, 12 fundamental market behavior principles, the easier it's going to be to develop it into a system. To give a further example, like think about a system based on price action. Okay, so breakouts are one of the fundamental concepts of market behavior. Compare that to somebody who is doing, for example, statistical arbitrage, which means, for example, looking at the options market to find the discrepancies in supply and demand and the discrepancy that causes in the pricing of the options. It's completely possible to do that. Statistical arbitrage, all of the hedge funds are doing it. But that's a far afield concept compared to breakouts, which you can readily see on any chart.
Right.
So if somebody comes to me and say, hey, you know what, I'm doing my first system, I'm considering trading, a statistical arbitrage system or something based on market behavior, what do you think? I would definitely try to convince them to work on the market behavior one, because it's a far more easier concept to implement. It's a lot easier to research. It needs lower scientific background. Like you don't have to have a degree in math, for example, to be able to do the statistics part. So it also depends on what you work on as a system designer. The closer that concept is to the principles of market behavior, the easier it is to develop the system, and the better the quality the end product is going to be, because there's less likelihood that you have to go back and re-optimize that system. Usually systems that are based on market behavior, if they are done correctly, they don't need more than one stage of optimization. It's not like, for example, indicator-based systems that you constantly have to go back every few months or few weeks and re-optimize your parameters because market changes, the indicator stops working, and then you have to change the input parameters for a system to bring it back to profitability again. Good systems that are based on market behavior, they rarely need any optimization. So that's the recommendation, really.
So we talked about the expectations for how long it should take to see some sort of success from trading. I think a lot of people want some kind of benchmark to understand if they're on the right track, if they're performing well. Obviously, there is one metric, which is, are you financially independent?
Mm-hmm.
But I think just in terms of mastering the craft, there's a metric of like how much what should I expect to make in terms of my return on a daily basis, on a yearly basis?
Right.
Can you talk through? I think these numbers will be surprising to some people. They're bigger than most people think, but they're actually quite realistic. And I'd like you to talk about that a bit, about what people can expect at a certain level of proficiency for a return on a daily basis and yearly basis.
I mean, I'm going to give my own example. Okay. So when I was consulting in telecom space as a network engineer and architect, I was paid hourly. Consultants in Canada are generally paid hourly. So they don't have a salary. It depends on the project and how many hours they put in it. My pay at that time was about $100 an hour. So my goal was to match that, which meant, so if I worked 8 hours a day, that would be $800 at the end of the day. So my goal was to at least get to that point. Then I thought about it and said, okay, so if you go to work, you have certain commute expenses, you have to have a car, use the toll road to get to the office, all of that. So I said, okay, if I'm trading, I'm not going to be having all of those expenses. So realistically, I can probably deduct $100 from all of that because I don't have all of those expenses. So my initial goal for my trading was to get to the point that I can comfortably make like $700 a day. Canadian dollars, not US dollars, so, which is roughly like 500 US dollars. And surprisingly, that $500 a day mark is kind of like above average income in a lot of professions in different fields. So I think that's based on current prices, it's a good place to start with. But everyone's different. So you have to look at your lifestyle, your trading account, because your daily income is also a function of your capital size and whether you can actually utilize all of that capital or not. There are a lot of my students who say, I have a good sized capital, but I'm afraid touching it because I'm afraid I can blow it up. So your skill level is also important. To work with some numbers, I think it makes sense to look at a chart. Let's look at the chart just as an example. And since I've been giving you examples about breakouts and second leg trading, just let's focus on that.
Yeah.
So look at this chart. How many setups do we have this day? And it's just a random day, right? So we have the initial big reversal at the opening of the day, one more leg down, so that worked. We have this breakout resulting in one more leg up, or this breakout resulting in one more leg up, two. Then you can say this was all a triangle. It had still reversals and second legs in it, but let's ignore all of that. Then we have this new breakout and one more leg down. And then this is good still, very powerful, very intact. One more leg down, reversal up, look for buying a pullback, one more leg up. So how many do we have today? The easy ones, 1 here, 2 here, 3 here, 4, and 5. So there are 5 really clear trades on this day. I think the initial goal should be, do I see all of those real time? can I take advantage of all of those real time? And I think that's even more important than your monetary goal. Because if you have a process oriented goal, which means here's my process, am I following it correctly and completely? And then based on that, am I executing cleanly and accurately on all of those? That is far more important than how much dollars am I making at the end of the day.
Right.
That's not very important. Because if you're following a process and the process is well established, which is again emphasis on systematic trading, then the income comes easy because the stress goes away. You know your process is going to take care of you. So the focus shifts from how many dollars at the end of the day to executing correctly on the process itself. So I think that is a lot more important than how many. And I was thinking incorrectly about it for a very long time myself. Like I was so focused on replacing my job,
Right.
that the process was missed in the mix of all of that. But really what is important is the process, not dollars at the end of the day. Because if you have the process down cold and it is completely mastered and you are confident that you can follow your process, well, you have confidence in the process to begin with, and then you also have confidence in yourself in being able to execute correctly on that process. When that is in place, the income from trading is automatic. You don't have to worry about it. It's a function of just being there, present, and executing our process. So let's take this chart as an example. If somebody was trading this with micro contracts, micro E-mini contracts, micro ES contracts. So you look at the price vector at the right side of the chart. Each line is 10 points, right? 4370, 4380, so there's 10 points. So let's say you capture half of it in each of these legs. So we had 5 trades, all of them were winners. So five points, that's 25 points. 25 points multiplied by 5 is $125 at the end of the day. So to get to that $500 mark, you just need to trade about 4 contracts, 4 micro contracts with a very simple process. So you don't need much, really. So small account, probably you trade 4 micro contracts, you need $20,000 to $40,000 account. But to explain, what the percentages are. Let's say let's say your process is established, and towards the end of it, that you're at the point that you're now starting to really focus on income part. So you're now fully into production mode rather than research and development mode. At that point, you want to make 3 times your cost of living. Whatever your lifestyle is, you have to calculate what your lifestyle costs. Whatever that number is, multiply that by 3. Because you have to make 3 times your cost of living to be able to pay for your cost of living and taxes and growth of your trading account. So let's say the trader calculated his cost of living as $50,000 a year. They need to make $150,000 from trading to be able to maintain a $50,000 a year lifestyle. And the reason for that is 1/3 goes to cost of living, 1/3 goes to taxes, and 1/3 goes back to the trading account. You have to constantly increase the value of your trading account, because as the index goes higher and higher and higher, the price on your trading goes up. To give you an example, when I started trading the E-mini futures, the margin requirement for E-mini was just $2,000. Now it's over $10,000. So I couldn't trade even the size that I was trading back then had I not grown my account up to now. So you have to constantly grow your account. Therefore, a portion of the proceeds for your trading has to go back to the trading account. Now that means if somebody's making 50% return on investment a year, they need a $300,000 account. And if they make 100% a year, these numbers, I understand, sound astronomical to a new person, but they are not really.
So would you say those numbers are actually realistic?
Yeah. They're gonna need $150,000 account. But the big question is, can you actually trade it? Do you feel comfortable putting on positions that have $2,000 to $5,000 risk per trade to be able to trade this? Most traders can't do that. So most traders have to start with a far smaller account and focus on that process of finding the trades and process of executing correctly on those findings, on those setups, so that they get to the point that they feel the confidence that they can take care of a 6-figure account. And then you can step into professional full-time trading. Those are the requirements. Now, as far as these percentages go, well, you can do simple math. So let's say somebody starts with $50,000, and I have some notes here to reference so that they don't mix the numbers. And their goal is to make 0.5% a day. So if you make 0.5% a day on a $50,000 account, you're making $250 a day. That's the revenue goal, basically.
So is 0.5% a day something that someone who's starting out and learning these principles, is that something they can strive for? Is that realistic to strive for?
Yeah, it is. Especially if the account is small, because when the account is large, then 0.5% is a big number, which means the risk is going to be proportionally bigger. And some people cannot handle the stress or psychology of having a bigger risk on their hands. But initially, I think it's fairly doable. It's actually a good target to have. So if you take, the 5 trades on this chart, all of them were winners. But let's say you mismanage some of them, or you don't take some of them, or you have losses, you're going to end up with that 250, because some days you're trading better, you get 5 out of 5, some days you get 4 out of 5, some days you get 3 out of 5. Some days you might, at the beginning especially, break even. So I think having the goal of 5 good trades with a very high win percentage and being able to at least capture a profit that's half of that, which is $250. If you trade all of the 5, it's going to be $500. So let's say at the beginning you make mistakes, you miss some of them. So it's fairly reasonable to look for $250. So if you consider that math, so at the end of day 1, you're going to be $50,250. So for the next day, you're going to be adding $252 mathematically, but let's say $250. So you're going to be at $50,500 for the second day. Day number 3, you're going to be at $50,750. And then day number 4 is going to be $51,000. So in 4 days, you made $1,000. Now, if you continue to add this and go up the numbers, you will see that at some point you have to add one more contract to maintain the 0.5% growth. It's not necessary to add one more contract, because you can also substitute the addition with a few more trades. So either way, you can get your targets. And then we have situations in between, like, your account is still not big enough to add one more contract, but you need the growth going to get to that point. So how would you tackle that situation? That is usually done by working a little bit more. So you hold some of your trades 0.5 point or a point more than your previous targets. You take a couple of more trades during the day, and that will push you past those barriers to get to the equity level that you can add now one more contract. At that point, it's easy then. When you trade with, let's say, 5, but there's a time between 5 to 6 contracts that you're not qualified to have 6 contracts, but 5 is also a little bit small. To compensate for that little bit of difference, you have to take a few more trades or hold some of your trades a little bit longer.
Depending on context.
Depending on context.
And then you also, when you were going through this chart, You also mentioned off camera that there are also a lot of little trades, smaller second legs that way as you get more advanced, that you can also take those. So those the five main second legs you mentioned were the bigger ones, larger structures. But then within that, can you show some of the smaller ones that traders will start to take as they get more advanced?
Yeah, certainly. So if you look at the chart again, so all of this leg down is just one leg because we have every high below the high of the prior bar up to this point. So we have 1, 2, 3, 4, 5 bars down. This is all one leg. This is the first break, first pullback, and that starts the second leg down. The way I like to teach people to trade these is actually with limit orders. So we would not wait for, let's say, bar 7, which is the low one short, to trade. My students will probably take a short up there with a limit order. But doesn't matter, either here or here. So that's one more leg down. Now on the way down, we see a possible wedge because this is actually the second leg from the bigger sell-off that happened towards the end of the prior day. And this leg down has 3 parts to it. So one part is here, down, pause, and down. So 10 is potentially a wedge reversal signal. You can buy that looking for second leg up. So that's the second trade here. So up to this point, we have 2 trades, one short and one long. Then all of this is in a tight bull channel, which means probably going to get something, a test up. So this is trade number 3 over here. And this is actually in a very tight channel. It's a micro channel. So it's going to hesitate or something. There's a small scalp here. Let's say we ignore that for now. Then we have a big reversal with follow through. And this traps all the bulls who bought on bar 14. So it's probably going to be a test here and a second leg down. First reversal, not high probability because of the micro channel. Second reversal, much better. We usually like to take this type of a trade in this kind of a situation with a limit order in the upper part of that sell signal bar. That's one of the techniques I teach. So this would be trade number 4 for us. This is a breakout potentially because it went below the low of the last swing point. And the last swing point was not a major one, it was a lower high. So this is potentially a bear breakout. It didn't get the confirmation, but the leg down is very consistent in a tight channel. Wait for a low 1 or low 2 short and sell again. So this would be trade number 4 right here. Now this is good to expect the second leg down. So trade number 5, selling the bad buy signal bar, bar 36. This bar 40, also has the same situation, same issue. Very tight channel, bad looking buy signal bar, doji basically. So it's going to result in a minor reversal or a pullback rather than a major reversal. You can fade the breakout, or just wait for it to fail and then trade. So here's the failure. Take the short on 43 or 44. 44 is higher probability. So this is trade number 5. Now we have a big wedge, 3 legs down or 4 legs down in a trading range day. How do we know it's a trading range day? Well, half of the day was spent in building a triangle. But the first reversal, low probability because of the tightness of this channel. So ignore this one. But if you buy it, you need a wide stop. There is potentially one more leg after this. So you can still trade for a short here or stay flat to catch the reversal. Both of them are reasonable, reasons to trade. So this would be trade number 6. Or if you ignore the sell here, this is a micro channel, 3 bars down, below the moving average in a bear market regime. So probably going to get one more leg down. So either this is trade number 6 or this is trade number 6. Then you have a double bottom reversal. Don't take the reversal, but look for the breakout and take the breakout. So now we have 4 bars up here, 5 bars up. You can buy and not wait for the pullback, potentially trade number 7, or buy near the moving average below these dojis and look for the trend resumption up. And that would be the last trade of the day. And in the process of explaining all of that, I ignored probably 80% of the detail.
Mm.
So this day had potentially 8 good trades. For a scalper, it had probably 30 good trades. So depending on your skill level, where in that process you are, from the very early stage, trader who just sees the bigger picture and takes 4 or 5 trades, to an advanced intermediate trader who takes about 8 trades, to an expert who takes about 20 trades. All of that amount of opportunities available on this chart. So the numbers that we talked about are not unreasonable. There is actually more opportunity than what I just showed to trade every day, and this is almost every day. And the days that the market have this type of a structure, a trading range day with one side showing more strength, those are more than 60% of all days, as far as the frequency goes. So there are a lot of days of this nature, which means part of the focus for a trader has to be on understanding day structure to be able to take advantage of the majority of the opportunities that the market provides for a day trader. The dynamics are different for a higher time frame trader, for a trader who trades, for example, on the daily charts. But for a day trader, part of the focus is understanding the day structure to be able to go from 4 or 5 trades a day to 10, 15, 20, 25 trades a day. But to get the numbers that we talked about, 0.5% a day or $250, $300 on a $50,000 account, is very realistic and very possible.
And that's with the 5 trades a day only, not even talking about the 8 and the 20 that you mentioned after. Awesome.
Now, if you think about a trader that has higher frequency, let's say they trade between 15 to 20 trades a day. They don't even need to trade at 5 contract level. They can bring that down to maybe half, 2, maybe even 1, and then build positions by scaling in and scaling out. So being a safer trader has actually several components. One is having a more detailed process, so you see more opportunities. The second part is actually being able to execute on those opportunities better. The third part is having a larger account, so you have more, like a bigger capital base. So each loss is a fraction of your account. A smaller fraction doesn't really threaten the buying power of your account all that much. And then finally, increasing the probabilities in your favor by being able to scale in and scale out. Mm-hmm. So when you scale in, you're basically tailoring your position to the market in hand. So you're adapting to the market more closely than a trader that can open with one order and close with one order. All of those combined together increase the probabilities of, making a really healthy income from trading a lot higher, because now you have multiple things working for you. But I think the most important thing of all of these factors is your process, how many trades it gives you, and your personal ability to really execute correctly on that process. These two are the most important factors.
Obviously, going from the beginner, taking 5 trades a day, trying to make 0.5% a day, and then going to intermediate at 8 trades, and expert at 20 trades, you're taking more trades, you're getting better at your craft. So you're going to increase your probability. You're going to avoid more losers, obviously. When it comes to just scaling up the amount, is it true that if you can make $100 a day, or if you can make $250 a day, that you can make $20,000 a day? Is the scaling up that simple, that it's just the same buttons? that create that multiple of income, or are there other factors at play? And what have you experienced in your journey?
Well, it's harder than it sounds, but at the same time, there's a technique to get around the difficulties. So um, this happened to me in a very bizarre way, and might be interesting to talk about it. So in 2019, one of my friends and I started an investment company, and the initial run up to produce the equity curve that you need for your marketing, we were working with some friends who were our early investors, and I put in some money, everybody put in some money, and the end result was that my trading account went from 6 figures to 7 figures and higher in a really, really short period of time. So I was trading comfortably my own account at the size that I'm comfortable trading. But then all of a sudden I was responsible for this much larger account without the run up to get to that point that you normally get to when you are trading your own account. So let's say your growth rate is whatever, 0.5% a day. You take some money out of your account for your expenses. So it takes, I don't know, like a year to double your account to a little bit more. Let's say the doubling happens every week. So this week it's double the last week. Next week is going to be double, and the week after that's going to be double. So you're going to end up with like 8 or 10 times your trading account, you're comfortable trading. And you have investors, so you have promised them that you're going to be trading their accounts. So position size goes up tremendously without the time to really ease yourself into that higher position size and bigger risk numbers and the numbers that you see on the screen. To give you an example, a good day for a trader who trades a 6-figure account can be, I don't know, $5,000 to $10,000 profit at the end of the day. For a trader who trades a 7-figure account, $10,000 is the open risk on an open position intraday.
Wow.
And then you have to take 10 or 15 of them. Because at that level, you're scaling in and out. So you're building a position and you're scaling out of it. And that means your risk, as you're building the position, your risk is incrementally going up as you add new contracts to your position.
Right.
And I was trading during the COVID crash. So market was very volatile at the time. We had 5-minute bars in one day that was 60 points tall. That was just one bar, one 5-minute bar. So imagine that you are trading the sizes that you're completely uncomfortable trading in a market volatility that's unprecedented. Like, you don't typically trade in that kind of a volatile market. That quickly pushes you to ignore the numbers and just focus on percentages.
Right.
And if somebody can do that, it's one of the best ways to achieve higher levels of success as a trader, because you wouldn't be bogged down by how many dollars are on the line right now. Right. And some trading platforms, like for example, TradeStation or MultiCharts, you can configure the price ladder to not show you dollars, but show you ticks or points. And I think that's necessary. And that's what I did. So you deviate from looking at dollars to look at points, because points are going to be the same.
Right.
If you're looking for a 5-point trade, it's 5-point trade. It's just that your position size translates that 5 points into a few $100 or tens of thousands of dollars. That's irrelevant.
Right.
But the psychology of it is actually not irrelevant. The psychology of it is very taxing on the trader. Now, I talked about the negatives, but let's talk about the positives too. Whatever you expose yourself to, you're going to get used to it. So the question here is, do you see it in yourself to push yourself and stretch yourself to the point that is uncomfortable, and stay in that uncomfortable zone long enough for you to get comfortable with the uncomfortable? The easy way is to not look at the dollar values, just look at points and try to hold your trades to get the number of points that you want to get based on your process.
Right.
The other way is to, some people are more comfortable to look at the dollars. That is a closer thing to their heart. They can understand it better. If you are in that group, you just have to push yourself and be okay with the stretch, because you cannot grow if you do not stretch yourself, which means you have to constantly stretch yourself.
So the one option is to take the money out of it, look at points, percentages. Don't look at your P&L on your screen. Just focus on the process. And there's another approach, which is just a brute force of just experiencing it, sitting with it, becoming used to it. I guess in that case, maybe smaller increments at a time would allow you to stretch more slowly and get more comfortable over time.
Yep.
You obviously didn't have that luxury because it happened really quickly for you. But is that a viable way that you just push yourself? Like, I think some people feel the discomfort and it's like, oh, maybe I shouldn't be doing it this way. But would you argue that there is a level of pushing yourself past your comfort zone so you can get used to it? Is that fair?
You have to, yeah. So I think the enabler really is the process rather than the numbers or your trading, because the process you put in place for your trading is ultimately what's going to dictate what the number is going to be. The more confidence you have in that process, the more confidence you will have in your execution, because you know that the process is sound. If I just shut down what I think right now and just follow my process, it's going to be okay. So that makes the execution a lot easier. But that's a stretch anyways. When you go from research and theory into implementation, that's a stretch. And a lot of people find, new aspects of their personality when they start to face the execution part of the systematic trading. But you get used to that too. That is one of the stretch things that you have to go through. Now, let's say the combined process and execution is now, implemented in, enough repetitions, enough cycles that now you have confidence in it. Now you look and say, okay, I'm good with the process, I'm good with my execution, I can trust myself. At that point, it will really help if you don't look at dollar values. Just look at points or percentages. And don't even think about the dollar values. It's like, let's say a doctor or an engineer goes to work every day. What is the focus? Income or the job? It's the job, right?
Right.
The doctor wants to help the patients. The engineer wants to make sure the project goes one step ahead and achieves the milestones in the project plan. But both of them get paid at the end of the day. But they get paid for doing a good job, right? So your job as a trader is just to follow an established process that you have confidence in without regard to how many dollars are won or lost. That's irrelevant. At the end of the day, when you look at your account, it's probably going to be positive if you do that. But if you don't do it and the focus is on the money, you will probably not make the money.
Amazing. That's a good way to put it. I like that analogy. Okay, so now we're going to dive deep into some trading concepts. And I think one thing that sets the tone for the day is to understand the opening gap and how the context changes throughout the day. So I think many people, including myself at one point in time, traded the whole day the same way. And you really talk about the details of how the day changes throughout the day. It's split into 3 sections. So can you talk a bit about the opening gap and how the day is split into 3 zones and how you trade them differently?
Yeah, so opening gap is actually one of the factors that are responsible for, expectations for type of day that we're going to have today. But it's actually an important one. So I teach my students to classify the gap into small, average, and large. And based on the 3 different types of gaps, not all of them have subcategories and things that we're not going to get into, but they set the tone for opening range, which means the first 1 or 2 hours of the day and the rest of the day. So definitely the opening gap is important. There's a statistical, like a substantial statistical support for this relationship between size of the gap and type of day that you're going to have. And there is the same kind of a statistical um, significance to the size of the gap and behavior of the market in the first 1 or 2 hours. Now, based on those, you can filter some of the setups in favor of taking or fading. So the same setup with relationship to the gap could be a take or could be a fade. Now, there are different techniques for taking or fading the same trade, but the gap gives you additional information on which one it is today, most likely, and what the probabilities are. So it's actually a very important piece of information. For years, I couldn't trade the opening 2 hours of the day. I just didn't understood the opening range, the dynamics of the opening range. So I would just show up around 11 o'clock and look at the market for about half an hour and start trading at 11:30 or 12 o'clock. Because by then, the first, let's say 18, 20 bars of the day has passed and everything is now sort of more clear. You have more information. Because you have more information, your decisions for the remaining portion of the day is going to be more accurate. And if you look at the entire day, the opening range to first 2.5 hours is the smaller portion of the day. So if you sacrifice that for better decisions in the 2/3 of the days left, it's probably a good price to pay for a beginner. So I used to do that for years, about 4 years. That was how I was trading. And then the day itself is actually 3 different time zones. So it's the opening to about late morning or early afternoon, depending on how the chart sets up. Then you have the middle part of the day, which is that part that is between the morning session and closing portion of the day. That's about 1 to 2 hours. And then there's the afternoon session that, depending on, again, how the day sets up, can start around 2 o'clock to 4:15, 4:30, or sometimes it can start at about 1:30. And that's the afternoon session. So usually, the middle portion of the day is where you have the most amount of trading range behavior. So most trades or limit order trades, fading breakouts.
Right.
The morning session can be the same, can be a trading range, or it can be, a breakout that sets up the trend for the rest of the day. So depending on day structure, depending on the gap, what today is doing to the prior day. Because each day is, on the daily chart, is the response that today has to the bar before. So you got to know what was before and what's the likelihood of today. And usually the response to the day before, at least in more than half the cases, is going to be the opposite in the first hour. And then that opposite fails and the market starts the correct response. So understanding all of those things are important as part of your trader's imagination. And then the afternoon is the response to the morning. So you got to understand what was the higher time frame, what did the morning do to the bar before. Let's say the daily chart has a high 1 buy setup. Morning, did it trigger the buy? Did it not trigger the buy? Did it trigger and pull back?
Right.
Did it trigger and break out? And now we have the afternoon. It's going to fail or succeed. And that usually happens in the final 2 hours of the day.
Right.
So trading each one of them has its own sort of like skill set. And it is also partially dependent on what happened before it.
Right. So typically the morning is going to have higher emphasis on urgency. So breakouts are going to be more likely to succeed. Same with the afternoon. And the lunch session, often more trading range behavior. So breakouts are more likely to fail. Do you think that should be implemented into a system as well, that you should trade different parts of the day differently and have different rules for them?
If you are a day trader and you are trading systematically, that's going to be one of the important filters that you have to think about. So the core concept is still breakouts for a breakout system. But that concept generates a set of signals that will tell you buy or sell or when, at what price. Those are not actionable until you have passed them through a set of filters. And one of the filters that you can pass them through is actually the time of day. So yeah, the answer is yes, definitely. For a intraday trading system, you're going to use time of day as one of your filters.
Awesome. So now we have a sense of how the time of day affects context, and you're saying it's so important that your system should actually include that as a filter.
Yeah.
Now, when you get to an individual trade, what is your approach for that trade? You see a setup, you see a breakout. Let's say you see a breakout on your chart. What are you thinking about when you approach that trade?
Every setup has 5 or 6 different parts to it. So the very first thing is to set an expectation for the trade. And that is the concept I call CE, for calibrated expectation, which means you look at the chart and you see your setup in the context of all the bars to the left. You also see the strength of the signal and the details of the signal. So all of those come together to set an expectation for the outcome of this trade. If it is within the boundaries of your process that you define for taking that trade, you can take that trade. But what CE also does is that it also sets an expectation for taking profits. Because let's say you have a stronger than usual setup and signal. By setup, I'm referring to the structure of the pattern leading up to that last bar, which is your signal bar. And by signal, I mean the bar itself. So let's say everything is stronger than the general norm of the market. You look at it and say, okay, so this is a strong setup. This is a strong signal bar in the strong setup. So probabilities are higher now. So you set a higher calibrated expectation for that trade. And that typically lets you to extend your profit-taking portion of the trade. So you take profits later, or you start a position with a bigger position size, or you start it same as what you typically do, but then you add on to the trade. So it changes the parameters for the system somewhat.
And these are all decided beforehand. You're not deciding on the fly. It's that if I see this, my CE will be this.
Yeah, you usually have a short list of criteria, and if the market is meeting one of them, you'll execute accordingly. So one of the parts that's very challenging for a developing trader, especially if they're not going the systematic route, is that they do not have an idea of these increments. And market is infinitely incremental. So where you draw that line is actually important, to go from option 1 to option 2 to option 3. For a fully discretionary trader, there are no options. It's like just one continuum of price action. And that line is very fluid. Today is here, 5 bars later is down here, 2 bars later is up there. So it is not like there's a real actual exact option for a discretionary trader. But nobody can trade like that. That's a very high level of skill set and experience. For everybody else, it's much better than that you have your options, knowing that they are very well defined, and there's a cost to that. The cost is that you cannot be as fluid and dynamic as a discretionary trader is. So when some of those guys are taking trades, your process is going to filter all of those trades because they are falling between your options, and you're not allowed to take action when it is not option A or option B or option C. If it is something between these, it's filtered by your process. So it's like, okay, I can't trade this.
Right. So it's the increased rule set, it puts you in a box, but that box has its benefits.
Yeah.
And it's that it gives you structure. Yeah, that makes sense. When going through my system, something I struggled with early on is where to put my emphasis on entries or exits. And you told me that entries are actually more important. So can you talk about your perspective on that?
Both of them are important, really. So it's not like at a level that you can ignore anything. For example, if somebody is a trend follower, there is more emphasis on exits in trend following systems. But if you are an intraday trader, the emphasis is actually on entries. I would say even for a long-term trend follower, entries are still important. It's probably more important than what you read in the literature, because in the literature, in the books, they say focus on exits and position sizing. But there is a real additional edge that's achieved through entries. And if you can design good entries for your system, the system is going to be a lot more robust. If you're trading lower time frames, like 5 minutes faster, even sub, let's say 4 hours. 4 hours is about half a day. So if you're trading like even a 15-minute chart, entries are really important. I mean, they are so important that in some cases, if you ignore the importance of the entry, your system actually going to break down. So entry is really, really important. There's a significant edge that the trader can achieve through good design for the entries. And that's one of the areas that I emphasize in whatever I teach, focusing people on entries, because if they read books, the books are going to focus them on exits and position sizing. Those are still important, but not as important as entries are for a day trader. In fact, out of the 3 parameters, entries, exits, and position sizing, for a day trader, entry is far more important than both entry, exits, and position sizing. And position sizing you can actually completely ignore, because you really do not have time to position size in a day trading situation. You open a position, you're in it for a bar or 2, 3, maybe 4, you're out. It's not like trading on higher time frames that you open a position today and this position is going to run in your account for the rest of the year, and you have 200 trading days left of the year, which you can pick any one of those days to add to your position. You don't have that kind of an opportunity in day trading. Day trading is usually short-term scalping, and swing trading intraday, especially for an instrument that has a high mean reversion tendency like S&P 500, is actually hard. So I'd like to focus my students on good design for the entries and not swing trading, because swing trading intraday is actually a high-level skill. And by the time that you get to the level that you can actually swing trade intraday, you probably don't need any systems. Your understanding is well established that you can make good decisions. But for a beginner and developing trader, I think there's a huge focus on good design for entries and good design for exits. And you can kind of completely ignore position size unless you want to scale in. If you want to scale in, the scaling becomes under positions. It's a position sizing topic. But even then, we teach people to look at the scaling in entry as a brand new entry. Like, you're flat and looking at the market. You have no position on, even though you also have a position on. But you're considering this entry in its own right without respect to what position you have open. If it makes sense, that's a good scaling in entry as well. So huge focus on entries, really.
Now I want to get into the breakout flow chart and the binary decision tree. So in our first interview, you shared this chart. So many people saved it and started to use it as their way of thinking about the market. So we're going to pull up some charts here and go through the flow chart and make some decisions based on context. So here we have a chart November 5th. And Ali, I want to get your take on bar number 4. So for those of you watching, bar number 4 is colored blue. So that's considered a breakout. And that's based on certain settings that Ali has researched. And all those settings and the breakout paint bar is available at quantsystems.ca in one of his professional programs.
Yeah. So as you know, this is the paint bar I wrote to teach breakouts.
Right.
And then we are also using it for system development and everything. So this is market's response to prior days wedge bottom here. So if you look at the corner chart here, 45 minutes, you will see the wedge down and a reversal up. And it formed a small higher low here and then a big breakout. So this bar needs probably follow through because first bar of the day usually goes in the wrong direction. But the context is actually good for this bar because the daily chart has a wedge that's reversing up. The intermediate chart has a wedge that's reversing up. And then on this chart, we are seeing initial breakout, which is the gap. It's a smaller gap, but very big follow through. So this bar, although it's the breakout bar, it's really the follow through bar after the gap. You can wait probably for one more bar to get a confirmation and then buy. So it's bar 2 now that you can buy. Also, I mentioned that first bar of the day has a very high failure rate, which means if the failure fails, the test of that failure point is also an entry. So what was that failure point? Close and high of the first bar. So there's also now a limit order entry. If you don't buy bar 2, there's a limit order entry at the high of bar 1 or at the close of bar 1. And you see the purpose of bar 3 was to test those prices. Now, whoever sold here, fading bar 1, they realized that the position was wrong after bar 2 closes like that. And then they're going to exit. And then there are bulls who are flat and looking, and they don't like to buy with market or stop orders. So they want a limit order pullback to buy. Now that they see bar 2, they're going to put their limit orders at the test prices of the prior bar 1, and then get filled here, and then the market rallies. So based on breakout process, we start up here. So what is the market? Always in long or short? It's potentially always in long, even down here below the moving average, because the price structure leading up to this these few reversal bars are a reversal structure. You have a wedge, and you have a bigger wedge here, so it's nested on the lower time frame. So market is probably shifting from a bear to bull regime, but we don't have any evidence for it. Bar 1 and bar 2 are evidences for always in long being confirmed. So always in long confirmed. Now you look at the next box. Is it a trend or a trading range? Well, if a wedge is reversing with this much strength, it's probably the beginnings of a trend. So it's probably always in long into a trend. So you go here, and then what do we have? Do we have the breakout phase or the channel phase?
So let's do it from bar 4. So bar 4 breakout, are we looking at a breakout or channel phase after that first implied pullback on 3? If you're looking at bar 4 for that criteria, would you consider it part of maybe a micro channel phase?
Well, as long as there are no visible pullbacks, you can conclude that it's still in the breakout phase.
Right. And for you, that's a spike break or a move below the prior bar in this case.
Basically, yeah. Basically, the definition of a pullback, which is price goes at least one tick below the low of the prior bar.
Right.
So we don't have any of that here. Therefore, we are still in the breakout phase. Is it a follow through or a reversal? Well, you see, it's a follow through.
Right.
So follow through.
So follow through meaning that it's going in the direction of the prior move?
Correct.
Right.
Yeah. The last bar. So this is based on every bar. So for every bar, you do this. So on bar 2, we are following through in the direction of the prior bar, which was a breakout bar.
Right.
So it's breakout and follow through. And by the way, that indicator is painting this lighter blue, which is indicating follow through after a breakout. So bar 1 and 2 was breakout and follow through, and bar 4 is still a follow through bar, although it is also breaking out. Follow throughs can break out as well, right? So bar 3 is not a bear bar. It has a bear body, but is controlled by the bulls, and the low is above the low of the prior bar. So it is still follow through from the direction of the breakout. And bar 4 is a further follow through, and it is also a breakout because it is closing with the high of the prior bar, and the bar is in the same direction as the breakout that is in progress.
Right.
So on the flow chart, we are still going through this part.
So we're always in long. It's a trend. It's the breakout phase, and it's following through based on the prior bar because both are bull bars.
Correct. Now we have to make a decision on the follow through. Is it strong or is it weak? Well, it's a strong follow through bar because most of it is a trend body. Most of the range of the bar is comprised by the body, which is a trending body. It's closing with the higher of the prior bar, and the tails are not all that big. So it is a strong breakout. Also, the fact that I want to add to this is that sometimes very strong breakouts are not desirable because they create climaxes. And this is not that either. So it's a normal or bigger than normal size bar that is breaking out strongly. So then that brings us to here. Do you accept the follow through? Is the follow through acceptable? Yeah, it is. So it's potentially a market entry.
Right. So buy the close.
Yeah, buy the close. You don't have to wait for even buy the close. As the bar is forming near the end of the bar, let's say bar is 5 minutes. So you want to enter early, not waiting for the close. You push it to almost the last 10-15 seconds of the bar, and then you buy at the market there. Because by the time the bar closes, the next bar can gap up and continue. You might not get a chance to buy the close. So if the follow-through is strong, you might able to execute on the market order entry, or wait for the close of the bar and then buy the close. Now you see here there's a contingency for climaxes, which is what I mentioned.
Right.
If the bar is suddenly too big, you might not want to buy the close.
Right.
And then you manage the bar based on climax characteristics of it. I say here, manage the exit, manage big bar reversal. It's also manage the entry. So you deal with the climaxes separate than buy the close, sell the close.
Right. Perfect. Okay, so that makes sense. Now, what if we go further down the line and we look at bar 11? It's also a breakout. It's also a really strong, it's still in a strong trend. How would you go through the flow chart for that?
All right, so at this point, let's look at our flow chart. We're still always in long. Is it a trend or trading range? Do you see any trading range behavior? Trending, so it's trend.
Now, what about the fact that you always mention that a 4-bar bear microchannel is the start of a trading range? How would you reconcile that? So we have 7, 8, 9, 10 as a 4-bar microchannel.
It could be, but this pattern is far smaller than the bigger pattern.
Got it.
And we haven't had any pullbacks yet. So yeah, there is a 4-bar microchannel going down with range compression on the last bar, with an inside bar, but it's also the very first pullback. So after a strong breakout like this, the first pullback is probably the start of the channel phase. All right, so we are in here. We are going right now, channel. Is it broad or is it tight? Well, there is not enough information at this point, really, to say it is broad, so you have to go with tight.
Right.
But we have a 4-bar bear macro channel against the trend that usually gets tested. So if you buy the close of that bar, the stop is below 9 at the closest. So it's not like I'm buying 11 and the stop is below 11 or 10. Stop is below the swing point.
Right.
And you see that the failure point of the macro channel was immediately tested by bar 12. So whoever sold here had a chance to exit. And that immediately tells us that the market is already in trading range. Because if bears can sell and not get punished for their bad trade, then the market is in trading range.
But at the point of 11, we didn't know that, which is why you made that assessment. But then after they're able to escape without a loss, now you can clearly say it's a trading range.
So by bar 12, you look at this. 12 is a reversal bar. It's an outside bar, so it broke below the low of the prior bar, so it's a breakout. It's a reversal. Is it major or minor? It's probably minor because the pattern is too intact. If it is, so it's not this part, it's not major, it's minor. Trade pullback setups or wait for the setup. So if it is minor, it's going to result in a pullback. You can trade the pullback, which means wait for a high 1 or high 2. Or if you understand what's going on, you can also buy with limit orders. Right. So here we have 3 bars going up. So buy below the low of the last strong bull bar, which is bar 10. Let's buy there. buy at the failure point of the bears who sold the doji high. You can buy there. Stop is still below the swing point at this point. Or buy with the high one buy signal. Here's your high one buy signal bar. It's not as great as we want because it's a smaller bar, it's an inside bar, but it is a strong bar closing on its high. So it's potentially a buy the close bar as well.
Right.
But the expectation is now a scalp because we concluded the market is in a trading range. Compared to earlier trades here, bar 2, bar 4, bar 5, the expectation here was breakout and second leg. Expectation here is now we're in a trading range. Bears were able to scalp the bad trade, break even. Okay.
Right.
So if you buy here, you are holding for 1 or 2 bars. Right. So
and that's your CE.
That's the CE of the trade. Right. So and you adjust it based on the information on the chart. So if this entire thing, parabolic wedge with 3 legs, is one single simple structure on a hard time frame, it's worth thinking that it is likely to have a second leg of its own. And now that we see the size of it, you can estimate what even a small second leg is going to look like. And that means we are probably going to go above 15 or 16 to establish the high of the day. So what I'm saying is that, yeah, we have a wedge, but it's clean and it is strong. So it's probably not going to be the high of the day at this point. It's not one of those situations where you have a parabolic wedge that establishes the high or low of the day within the first 20 bars. This is correcting a major structure on a higher time frame, and we are seeing a breakout. So it's probably going to go above the high of the day established by 16 and produce something that is of a second leg nature. Even if it is unbalanced and smaller, it's still going to be significantly bigger than 1 5-minute bar.
Right.
So potentially one of those diagnoses for an intraday swing.
So when you see bar 11, would that make you hesitate to buy the close and maybe treat it as a trading range or treat it as a channel so that you buy lower instead of buying the close? Or do you think it's still reasonable to buy the close because of the fact that it's a strong breakout and it's after the first pullback?
That is fine. But in this particular situation, because bears really do not have much, look at everything that bears have up to bar 11. There's only one bear bar, and that's bar 8. Okay, so everything else is a series of bull bars. Plus, they have a macro channel that is not all that strong. So I think the correct assessment is you buy the close of 11 with an option to scaling.
Awesome. Yeah. Got it. So you're saying don't skip it because the bears don't have anything, but have some more bullets for lower.
Yeah. And if you are trading a bigger account, usually your position size is not enough to saturate the account. So there is a very big advantage of being capitalized enough for the size that you're trading. And that's different for every trader. Like, for example, a trader that wants to trade 10 E-minis, for example, they're going to have a bigger 6-figure account. But they're not going to be using all of that account. It's for situations like this that you don't want to reduce your position size, but you want to have the option to add on. You can add on. And that's actually probably 90% of all of the entries are markets in a situation that the entry is good, but you also want to have extra bullets left to fire at it if it pulls back, because it lowers your cost average and gives you an opportunity to exit earlier with the profit that you want to have on the first trade at a smaller size. So there's a big advantage of being able to scale it. Yeah.
Awesome. So let's move to bar 20. How would you go through the flow chart for bar 20?
All right, so bar 20. Well, the first question is always in long or short. I think we are still always in long. Market's above the moving average. Moving average is steeply up. By the way, the color that you see on the moving average is another indicator that are programmed, and it measures the angle of the moving average and classifies the moving average into 5 different categories. Strong bull trend is light green. Weaker bull trend, like here, is dark green. Same colors, weak and a strong bear trend, dark red and orange. And then trading range when it is narrow and blue. So it has a 5 state classification for the moving average. And it's for easy decision making, especially as a training tool. So when you're looking here and making decisions always in long or short, if the moving average is steeply up and it is light green, market is always in long. Price is above, moving average is up, it's steeply up, so it's always in long.
Right.
Bar 20 is potentially a double bottom bull flag in a strong bull trend. And I already talked about why the market should go above 16 high. So although we have 4 bars down and 2 of them are strong, this is a legitimate double bottom bull flag. It's this second attempt down, first attempt down here, second attempt down there, and it's the first test of the moving average in about 20 bars. So there are a lot of things going on for bar 19, but 19 is a doji looking buy signal bar for the double bottom bull flag. So you need one more bar. So here's one more bar, bar 20. It's another breakout bar, very strong close, very strong bar. The only problem with it is the leg down might hesitate before it goes up because of the strength of the leg down. So okay to buy 20, stop is below 19 low. And the assumption is that we're going to have a hesitation before the market resumes. But the same CE is telling us new high of the day. So new high of the day after a pause. So if you are taking the trade, you shouldn't be disappointed by a pause. And this is one of those beginner situations when they take the good trade and there's a pause. They don't estimate the pause. They don't think the pause is going to happen, but it's going to happen. And then they close the trade immediately with a small loss, a few ticks maybe. And then they miss the trade.
Yeah, I think that those 2 layers are so important, that knowing that we're probably going to go above 16, so knowing that expectation and knowing that we're also probably going to hesitate, it gives you so much peace of mind and knowing what path the market is going to take to get to the target it's probably going to reach. And I think that level of understanding is why experts like yourself and Dr. Brooks say that you can stay calm when you're in a trade because you've already thought all these things through. You know what to expect. So when we look at 20, let's pull up the flow chart and go through this process. So we're always in long. We see the moving average is light green, still in a strong bull trend. Now we had a strong bear move down. It's a double bottom bull flag. Would you classify us as now in a trading range, or are we still in a trend?
All right, so let's go back to the chart. As long as you're in this kind of an environment when 2 sides can trade and scalp, you're in a trading range.
Got it.
But the point that most traders forget is that the bull trend itself is built of periods of trend, trading range, trend, trading range. Every time there's a pullback, you're in a trading range. So the pullback, sometimes it's simple, like here, just 1 bar or a couple of bars. Sometimes it is more complex, like the rest of it, which is sort of like an expanding triangle. But it's a pullback. Every time the market is pulling back, it is in a trading range because you have a move against the prior move. And that's the minimum definition for a trading range. You have a leg up followed by a leg down. So market's in a trading range. But you also have to remember that trends are comprised of periods of breakouts and trading ranges. Look at this chart. All of the bars in this portion of the chart that are not going up are forming trading ranges. Some of them are dojis, 1 bar trading range. Some of them, like 24 inside bear bar, is a 2 bar trading range, 23 and 24. So depending on how the market shapes that trading range, trading ranges form inside of trends, but they are usually continuation patterns. So market eventually breaks out of the trading range and goes to a new high. So on 20, the expectation is we're going to hesitate and go higher, but we are still in a trading range with an expectation of a break above the old high of the day. That was the minimum expectation which happened here.
So for bar 20, If we look at the flow chart, how are we making our decision for our entry?
All right, so at this point, we are still always in long, but we are in a trading range portion of a trend. And trading range seems to be wide because it has legs with 4 bars in it. So it's bigger than 1 bar. So you have to trade in the direction of the always in, which means don't short, look for buys.
And so is that buy the close, or how are you going to buy that bar?
You're going to buy that bar knowing that the market's going to pause. But the expectation is that we're going to go above the high of the day. So the trade is still a long trade with an option to scale in lower. And if you look at the opposite side, bears probably sold above 18 high. And if you are in a trading range, that gap should close. So the limit order is to buy at the high of 18 when, bears who sold here and they see the breakout, they see the high 2 reversal. They know the trade was wrong. So they have to exit there. So you buy with them when they are buying to exit, you're buying to add to your position.
So when you're in a trading range, you may still buy the close if there's a target above, but then you also look for areas of support where bears might be trapped or just in the lower third, somewhere in the lower third. In this case, you're saying there's a 4 bar bear micro channel. Bears will sell the 18 high, and they'll get filled on bar 20, but then they get a small surprise against them.
Exactly.
So when they get a small surprise against them, now they're trying to exit break even, and you know that.
Yeah.
And so you're going to buy where they're exiting their shorts.
The other thing is you can actually skip the buy on bar 20 to buy lower with a limit order, but there's a cost to that trade. The cost is missing the opportunity. So if you don't want to miss the opportunity, buy a fraction size position or have enough, capital to add to your normal size trade, but scaling lower. If you're okay with losing the opportunity, which is fine, I do it all the time. I'm basically more than a breakout trader. I'm a pullback trader myself. But I understand the cost of the opportunity. The opportunity is that sometimes you get strong follow through and don't get your pullback. And by the time you get the pullback, it's already too late. So you have to have thought about it beforehand and be perfectly fine with missing roughly about 20% of opportunities. But the day has 70 tradable bars. So you miss 1 or 2 trades, doesn't matter. There's something else set up 3 bars later. So
right, you find what you're comfortable with, knowing that there's going to be another trade, a better later trade.
Yeah.
I think this is interesting because I think something that I struggle with a lot is when I see 20 and we're in a trading range, my thought was always, oh, it's a trading range, so I shouldn't trade it. And what I learned from you is that it just means that you may not have as much urgency. You still want to trade in the always in direction, but you may look to buy lower, or you may look to buy and buy more lower. But it doesn't necessarily mean skip. You have to understand the whole context about, for example, we're probably going to get to a new high of day because it's a parabolic wedge, but it's in direction of the trend. So we're probably going to get trend resumption. So there's so many factors that go into it. And my decision making was mainly trading range skip, but that's not all that goes into it. Yeah. There's usually more than that. And the more small things that you see, the easier that decision making becomes, but only after you can process all of that. Right. So to give you an example from my development stage, I used to get so tired after 2 or 3 hours of trading that I actually had to take a nap. But now I look at the chart, everything is evident with just the first glance. So the processing pressure that used to be there is not there anymore. But I still hear from my students that they say we get very tired after half a day of trading. And that is because now they are seeing all of these little details, but they are also processing them actively. When you build your experience, you don't process them actively. You just see it and you know exactly what it is. But for a developing trader, they see the little things and they have to think about them actively. Those automatic responses are not completely naturalized, let's say, at that stage. So it makes them tired. Awesome. Okay, so let's do our last breakout for this chart on bar 25.
Yeah. All right. So on 25, the market does the minimum thing that was expected from this parabolic wedge to go above its high. But look at how the market gets to 25. Do you see any pullbacks?
No.
No. So this is all one simple breakout leg on one time frame higher.
Right.
So you have a macro channel that's forming the high of the day, which is basically what this day has been doing since the beginning in the morning. We have a very tight channel up. This is a micro channel on the 15-minute chart, leading to a pause and a new high of the day. We have a new high of the day formed by a macro channel, which is a parabolic wedge, should pause and lead to a new high of the day. That's the tempo of this day. That's the behavior of the market this day. But we're approaching that middle portion of the day, which means more trading range price action is expected anyways. But 25, 3 legs up, it's going to pull back. If you buy, where's your stop? Down here. If that's too big of a stop, don't take that buy because it's already a little bit late. But it is a breakout. It's just that it is a bit late in the sequence.
So we're still always in long. Are we still in the trading range or now we're trending again?
There's always a mix of both. But if you look at this chart, by the time we have 25, all the breakout gaps are closing. So the expectation is that this one is going to close as well. When breakout gaps are closing, even though you have this top of a macro channel, the expectation is trading range behavior. So we are still here, but we are in a tight trading range, probably up there. So you can wait. If you consider one time frame above 5 minutes, then on the flow chart, you are actually here. Your trend, you're in a tight channel, and you can enter always in long.
Right. So it's about, like, to your point, the trader's imagination, that flow chart may be one thing on the 5-minute chart, but another thing on the 15-minute chart, and you have to reconcile those two things.
Yeah. Good traders see both. So they look at this and say, all right, this is a simple breakout leg, one time frame higher. I don't see any pullbacks. I know this is a leg in a trading range, so it should pull back. But it shouldn't reverse completely. So there is a limit order buy somewhere here. Or they wait for the pullback to become a pullback, which means every pullback is a reversal. But if the reversal stops to reverse and trend resumes again, then it's a pullback.
Right.
When do you know that? When you see bull bars again. So they don't take the buy, they don't take the sell, waiting for always in long to regain control. That control is regained on 28, 29, 30, any one of those bars. So that is another buy. And by the way, we've had one pullback here, first pullback. So some traders will actually buy below that doji looking bar there, expecting it to be the first pullback.
Perfect. Okay, let's do one more chart. That was really helpful. Let's do November 6th, so just the next day. Okay, perfect. So let's do bar 4.
Okay, so on this chart, we have a very big gap up open. This is another indicator I wrote to measure breakout gaps. Sorry, to measure the opening gaps. And it tells several different things. The first number on the left is the size of the gap in points. Then we have this marker, which if it is a big fat marker like this, it's indicating it's a big gap. And there are 2 percentages here. The right-hand side percentage is showing what's the ratio of the size of this gap to the average daily bar. And in this case, it is 263% of an average daily bar. So if whatever the size of the average daily bar is, this is 2.6 times bigger than that. And the number in the middle is showing how much bigger this big gap is compared to the last time we had a big gap on the chart. And this is 2.2 times bigger than that. So it's a really big gap. So big gaps or big breakouts, as you see on the 45-minute bar, 45-minute chart here. It's a big gap up. They set directional bias usually for the entire day. So if it's a big gap up, it's mostly going to be bullish. There are obviously failure expectations too. In this context, the market is in a bull trend on a hard time frame. We had a wedge reversal and we have a very big gap up. By the way, this chart is the Globex chart, right? The Globex chart doesn't show the gap, but it shows the gap as part of the bar itself. But you see the gap here on the day session chart, and this chart is also day session. Big gaps set certain expectations for the day. One of them is that the day is generally going to be a type of a trading range day with a bias in the direction of the gap. So it's a bull gap. It's going to be mostly trading range with bulls being more active throughout the day. On top of that, you usually get a tradable bull leg in the first hour. And if the market reverses and goes the other way, you usually get a strong reversal attempt in early afternoon. Those are all the CE expectations of big gaps. Now, the first bar is a bear bar, and it is followed by an inside bull bar. So basically range compression far above the moving average. Those are an indication of the trading range price action that we just knew even before we looked at the first bar based on the size of the gap.
Right.
So if bears get one more bar, they're going to sell. So that would be for them second entry short on the open, and they take it. Now, if the day is going to be in a trading range type of a day, then qualities of these signals are going to be suboptimal. Okay. So for the bears, you see they have an outside bar, which they don't like for the signal bar. So we have a reversal down, two legs, one, pause, two, on bar 6. But the expectation is you're going to get a bull leg in the first hour. So although this is all good to expect a second leg down, the market is in a trading range. If it is in a trading range, even strong gaps are going to close. So you expect the market to overlap at least low of 1. Therefore, when you get the first signal or the second bar breaking out above it, then that's an indication that the market can be going that direction to close the gap.
Right. Okay. So from the perspective of just seeing bar 4, let's say we haven't seen 6 and 7 yet. We see bar 4. You could look at it and say, okay, there's a tight trading range above the moving average, far above the moving average. Probably has to revert to the mean a little bit. So I see 4 and you think, well, I think it's going to get to the moving average. So how do we go through that flow chart and make that decision that should we take it? Should we pass? Should we take it in a more conservative way? How do we go through that flow chart and make that decision?
All right. So what was the last breakout on this chart? The gap.
The gap.
So this is a breakout against the gap, and it is fairly strong. When you have two strong opposing forces, you're already in a trading range. So if you look at our flow chart here, definitely always in long. And are we in a trend or trading range? We are in a trading range. So we're here. Is it tight or wide? It's probably wide.
Right.
Because we're not seeing the tight trading range formed. We don't see a lot of overlap. Wide trading ranges produce gaps. So they have legs that have gaps in them. But then the gaps close when the subsequent leg starts to reverse. So it's probably wide. You have to trade in the direction of the always in. And we know from the information on these charts that the always in is long. So if you take 4 as a breakout short, it's probably just for a scalp because you have to be trading in the always in direction.
Right. So it's a skip or very, very quickly managed trade.
Yeah.
So how about bar 14 on this chart? Can we go through the process for that as well?
Sure. So we know that we are in a trading range. We know that because of the opening gap, there was a very high likelihood of a bull rally in the first hour, and we have that leg up to 12. But the move from 6 to 12 is very consistent. And usually when you get that much consistency, you don't immediately reverse down, especially in a bull market environment. And that comes from higher time frame. So 1 to 6 down was supposed to have a second leg of some sort, and 6 to 12 up is supposed to have a leg up of some sort, which means you're going to be still in a trading range going sideways. So if you take 14 as reversal and follow through, 13, 14 from top of a trading range, it makes sense. But because we are in a trading range, the expectation is a scalp only. You're not taking any of these trades for a swing. Sometimes they turn into swings, but it's better to miss the swing and enter later on something else than expose yourself to a lower risk trade. So 14, not a good short, low probability. What about 15? Now we have follow through. Well, now the probability is much higher because you have 3 bars. But whenever the probability is high in a trading range, you usually also get a pause. So the expectation is we're going to go down a little bit more, but there is going to be a pullback too. We get the pause on 16. 17 is the minimum expectation, 1 more bar down. And the rest of it is really not good to trade 18 and 19.
So from, obviously we have the reversal bar on 13, so no breakout in this time frame. It's inside bar. But then 14 is the first breakout. So you see signs of strength, that you have 2 bear bars in a row, you have a bear breakout bar on 14. Can we go through the decision tree to figure out how to act based on this if you're thinking systematically? So we know we're always in long still. So that's the first option. And always in long typically is skip shorts or scalp.
Yeah. So we know from our assessment that we are always in long. We are in a trading range. Trading range is wide because it is producing tradable legs and it's producing gaps. You have to trade in the always in direction. And always in direction is so far above the moving average after a big gap. Don't forget, big gaps are also climaxes. And usually when you have a climax, market goes sideways. That climax on this chart took the entire overnight session to form. So a couple of hours of sideways is not out of the realm of possibilities at all.
Right.
So you have to trade in the always in direction, which means you're still looking to buy.
Right.
Or if you're taking shorts, that's just for 1 bar, or those are just short-term scalps.
So where in your assessment of what to do here is seeing the breakout 14, knowing we're always in long and that we're in a wide trading range, where does the size and the location within that trading range play a role?
Right.
So for example, it is a trading range and we are always in long, but we're high in the trading range. So I guess your assessment is because we're always in long, you have to be careful. So either skip or scalp. And you can scalp because we're high in the trading range, that there's still room to the middle or the bottom of the trading range.
Yeah, so the best way of trading in trading ranges like this is to look back to the left side of the chart and see what was the most reasonable trade that failed and use that failure point as your entry for the new trade that you want to take. Like for example, up there, there was a high 1 buy setup on bar 2 and it failed. So market went above the high of 2. I don't suggest that people take this type of a high 1, but from a technical analysis point of view, it's still a high 1. So the high 1 triggered and failed. This is testing that price. So it's probably going to at least have a reaction to it because those who bought and bought lower, they're going to exit. For the bears had a decent micro channel and it was reasonable to sell above 5 high. So if they sold above 5 high, 5 high is now support because it failed as a resistance level. It was tested briefly here, but I teach my students that brief tests are usually not enough. And I don't want to get into details of that because that's an hour of discussion. But that support level is now present because resistance failed and becomes support. So if you want to buy, wait for a 2-legged or 3-legged test to the top or bottom and then start taking that trade. at the prices that the other side failed. Those are very reliable trades. You can consistently find them. They're probably going to add at least a 20% to your edge, whatever it was.
So because we're in a trading range, are you also making the assessment that even though 14 we're still always in long, that there's a decent chance that we're going to test those to close those gaps in a trading range?
If the trading range is a broad trading range, you're going to see two things. You're going to see trend legs and you're going to see breakout gaps that close, which means trends are not reliable and gaps are not going to stay open. Therefore, yeah.
Awesome. Now, what about bar 24?
So by bar 24, we have another reversal up, which we knew is quite high probability based on the consistency of 6 to 12. So we're expecting one more leg up. And we are seeing trend resumption on 24. And there's a shift here that's happening between bears and bulls. Bears are losing their consistency. Bulls are gaining more consistency. So the case is becoming better for the bulls progressively. Like, if you look at the opening range of the day, very big bear breakout failed. Then we have a second breakout attempt. And this looks like failing over here because we're getting bull bars and reversals. And now bulls are reversing. The first reversal up was very good. This is much more consistent and controlled than everything that bears had up to that point. Bears really have nothing here. They don't even have any bear bars. These are all controlled by the bulls. And if you think about this as second leg down, which has three parts, so wedge or parabolic wedge, test of the prior, support. Now you have your first reason to buy on 20. You have your second reason to buy on 21, reversal and follow through. And then there's a high one pullback, which is not good, 23. But the entry bar, the follow through bar is very good, 24. So if you don't buy the high one, you want more confirmation. Here's your more confirmation. So 24 is a buy the close bar. The only problem is it's very close to that high of the day that was established at the beginning. So if you buy, it's still in a trading range. Everything is a scalp.
Okay, let's do 33. It looks like we just had a tight trading range to 32, and now we're breaking out. Is 33, we're always in long, it's a breakout. How do you classify this in terms of how you're going to approach this trade?
Right. So usually when you're at the top of the trading range and the way the market gets to the top is within a few legs, that last breakout is a very low probability breakout. So that is against the probabilities for 33. So bears have nothing except the environment. Environment is still a wide trading range. So wide trading range, you expect mean reversion, okay? You have multiple legs to top of the trading range. So that's automatically disqualifying the buy. The other thing is we have a big gap up day, which is 2.6 times bigger than an average bar range on the daily chart. When that is the case, you can still trend in that direction, but that caps off the extent that the market can move intraday. Because if you look at the daily chart, usually bars are of similar sizes and they tend to gravitate to that average. If the bar is suddenly so much bigger than the average bar size, in this case 2.6 times bigger, just on the gap open, what is left for the rest of the day to accomplish? There's not much more left.
Right.
So that automatically discourages people from buying, expecting a trend intraday, because that is the lower probability assumption. It's not going to happen. How many times do you see a bar on the daily chart that's, let's say, 4 or 5 times an average bar range?
Very rare.
Very rare. The chance of this day, for this day to be one of those days, is equally rare. So that means if the market is near the top of the range and you see 3 legs or 4 legs to reach that price, that last breakout, even though the bar looks good, is probably very low probability. So it's one of those skip situations. In addition to all of that, we are seeing potentially a triangle on 33 that is incomplete yet, but it has 5 legs. 3 going up and 2 going down. So any trading range with 5 legs in it is a no-touch pattern. You cannot trade it.
And the first leg is the gap up?
Yep.
Right.
So gap up is the first leg, second leg up, third leg up,
Right.
okay, and 2 counter legs down to 6 and down to 19. So we have a 5-leg trading range that is compressing the range. Because there is a range compression, it's a triangle. And because there's 5 legs in it, it's almost complete. So the market is really in breakout mode at a situation near resistance. It's one of those few times a day that you have to fold your arms and don't touch the mouse and say, all right, I'm going to wait.
Right. And to your point about the dynamics of the big gap up, even though the distance traveled between bar 6 and bar 76 looks like a big bull trend, the actual displacement of the day from the open to the close is actually very, very small. Yeah. So it didn't actually move a really large distance from the open to the close, even though it traveled a large distance.
Yeah, that's good.
So based on that, the idea that we're probably not going to go much further, we're at the top of a trading range. How does bar 40 differ from bar 33? Can we go through the flow chart for bar 40?
Yeah, so 40, we are still always in long on bar 40.
Right.
And this is a new high of the day now. But 40, so if you go to here, we're always in long. Are we trending or in a trading range? As I mentioned before, there's usually a combination of both of them. But in this case, at this point, if you look from back here to your swing point, you have a spike and channel bull trend. So it's in a trend, which is building a big trading range, and we seem to be breaking out.
Right.
Based on 33, we knew that the market was in breakout mode. So we're expecting a breakout up or down. Therefore, this could be that breakout up. We have a new high of today. But the bar is not significantly above the old high of the day, which was here. It's not a very big bar, but it is still a breakout bar. Every situation is different. In this particular case, the move really started with 35. And from 35 to 40, we really don't have any bear bars. So it's 3, 4, 5, 6, 7 bars up. So there's a lot of consistency here in going in one direction and not going too much in the opposite direction. This is also a macro channel. So it's another version of this.
Right.
But in a smaller, more miniature way. So another leg up is expected. But because 40 does not go decisively above the old high of the day, you also need follow through. So if you buy this bar, the expectation is you need follow through, and the pullback shouldn't become a big bear bar.
Right.
If it becomes a bear bar, even though you're not stopped out yet, it's better to exit because it's a weak or a small breakout of a big triangle, and those have at least 50% failure rate. This is a slightly different case because bulls are showing a lot of consistency in building the triangle, so they're more dominant in the structure that they're building. You can trust a little bit more. But if there is a bear bar here right after your entry, it's better to exit. The other entry technique in situations like this is that you don't take the entry on the breakout bar 40, but you don't short either. So you're flat and looking. You look for either tests or bad setups for the other side. So if the other side gets a doji sell signal like 42, then you can buy that because that no bear is going to take that. There are very few bears that are going to take bad signal bars. So 42 is a bad short. It means it's a good long, which means you can buy the close, buy below the bar, whatever. Another way is to wait for the breakout to start to resume and buy higher, which means that would be not on 43 because 43 is an outside bar. Outside bars need follow through, but 44 is the follow through bar and it is a strong bar, so you can buy the close of 42. So that's how you handle the situation. So on that bar, we are always in long. We are trending in a trading range we just broke out of. So you can say, because there is a breakout, we are a trend, so it's a breakout. Is it in a channel? If you look back at the chart, it is in a channel. Okay. But because the market was in breakout mode, you can also consider it as a brand new breakout. If you consider it as a brand new breakout, then it's follow through. Okay. And is it strong or is it weak? It's still quite strong because we have 7 bars up. We haven't had any bear bars. So you come here. You cannot enter at the market because I think it needs follow through. But you can come here and wait for the bar to close and then decide to buy the close or not.
So based on this, if you're uncertain about if it's strong or weak follow through, maybe you say it's strong and you buy the close, or maybe you say it's weak. And to your point, if you think it's weak, then you wait to see the follow through. You wait to see a bad sell signal and then you buy. So that's up to the trader to decide based on context.
Now, if you think it's a channel, you have to look down here. Is it broad or tight? It's a tight channel. Then you have to enter in the always in direction. Then you're always in long, so you can buy in that direction. Now, this flowchart doesn't really go into how you enter.
Right.
That's a different topic, but you know at least that you shouldn't short, which is great.
Right. And then the entry options are the ones you talked about. Like you can buy where bears are exiting. You can buy at support. You can wait for a follow through bar and buy the close of the follow through bar. Got it. Can you pull up November 12th? So for November 12th here, can you talk through your decision-making process for bar 7?
So look at the open of the day. You have a small gap open, small gaps, and it's a bear gap. Okay, it's red, bar went lower. Small gaps usually close immediately or within the first hour or so. This one was closed on the same bar. The high of the day was formed by bar 2, and it is 3 legs up from here, 2 and 3. So potentially a wedge. And where is this wedge forming? Look at the 45-minute chart. We have a strong leg down here with a pullback. That pullback was the rally that we had the day before. You see the tail end of it here. And we are forming a wedge with a reversal bar here. So the opening range is a triangle. So breakout mode on the open. Market's going sideways and compressing the range into a couple of dojis. So you wouldn't do anything here until you get, good follow through. But market is in breakout mode, and it is above the moving average. This time frame, that time frame, so it is always in long. But the problem with that is, it's producing a breakout mode situation. There's a wedge that needs a correction, and it's potentially one of those times that you have to wait for information. So now we have the information. It's a bear breakout of the opening range triangle, bar 7. 7 needs follow through. But if you're making a decision on 7, you go to here. Prior to 7, we were in wait situation. Can't decide. But here, you have to decide, are we always in short? Probably. This bar has the majority of its range below the moving average, and it's a strong close below the moving average, and it is coming from a pattern that needs a bear correction. So all boxes are checked, therefore probably always in short. Is it a trend or trading range? Well, it looks like it is flipping over to a trend because it used to be in a trading range before. Which phase, breakout or channel? It looks like it is a breakout. Is it a reversal or follow through? Well, it's the first bar, so you have to consider this side, follow through. Is it strong? Yes. So you can decide based on, direction, which is short. But most traders also know that when the market flips to always in long or always in short, when the market regime flips, there's usually an attempt to reverse it. So flip is usually followed by a trading range and then trend resumption. So if you sell the close of 7, stop is up there, and the expectation is we are going to be in a tight trading range below the moving average for a few bars. What is few? It's somewhere between 4 to 8. Sometimes it's just 1, but you have to be prepared for that. So if you take 7 as your signal, it is really a swing situation. It's not a scalp because we haven't seen the follow through yet. And we know that it's a very high likelihood that the market goes sideways before it starts the trend. So it's one of those situations where you sell with an option to sell higher.
Right.
If it doesn't go higher and goes for you, then the next bar is a bear bar. Then you can put the next piece of your position back on there. So if like 8 is a bear bar, looking like bar 10 here, you sold half your position there, you will sell half the position on the new bar. But if you see 10 is a bad high one. So the sell is now automatically a limit order fade above the bar. And you look back to see where was the last place bulls failed. Whoever bought the low of the day won. They failed. So there is that price. There's the midpoint of this bar, and then there's the moving average. Pick one of them and stick with that price.
So that's your point about, yes, it's sell to close because it's a strong breakout, potentially starting a new trend, but the context tells you the extra details of what to do. So yeah, you may sell to close, but also based on the context, you know that it might retest the moving average or pull back. So you have to have, you want to have an option to sell higher as well.
Yeah. Whenever the market immediately crosses the moving average and immediately becomes always in short or long, there's a very high likelihood of a trading range forming first before there's more follow through. If it happens in the other way, like what we see on bar 42, 43, 5, 6, the market is becoming always in long below the moving average. When the prior pattern makes sense, it's a wedge with the climax reversing. Then crossing the moving average might not result in a tight trading range because we are already established in a bull market regime.
Right.
But if you flip the market regime by crossing the moving average, and it's all done by one bar, then usually market goes sideways first before the direction is established.
That makes sense. Okay, so how about bar 15 now? You said that was an interesting bar. What makes it interesting? And let's go through the flow chart for that one.
All right, so at this point, we had a high 1 and a high 2, bar 13, and both of them failed. So if you look at the entire pattern, 15 might look like third leg down, one here, second one to low of 13, and third one to 15.
Right.
But the difference with other wedges here is that the entire pattern on the higher time frame was a pullback that finished yesterday or early today. Look over here. Big wedge is starting its correction. It's had one leg down with the pullback, and the second leg down is expected. So higher time frame is expecting second leg down. And second leg down has started with 7. You're always in short. So you really shouldn't consider 9 to 13, 9 high to 13 low as a bear leg down. It's mostly tight trading range after market became always in short. So always in short, tight trading range, trend resumption.
Right.
So 15 is probably trend resumption. And if this entire pattern today intraday is correcting the 45-minute chart, it shouldn't stop on a bar that's only 5 minutes. There should be more to come.
Right.
So 15 is actually a signal to the bears that, all right, bulls tried twice to put it back to always in long. They failed twice. Now we're going down. So 15 becomes trend resumption. Now, based on, that's the context and CE. Based on this, we were always in short.
Right.
We are in a trend.
Right.
It's a breakout bar, so it's breakout phase. Sorry, it's not breakout phase. We are resuming from a pullback, so it's the channel phase. Is it broad or tight? Look at the chart. It looks tight to me.
Mm-hmm.
Tight is when you don't have legs that you can swing counter direction, right? So like the
Right.
previous example, we had bars, that series of bars going in one direction and then reversing. And we don't have breakout gaps in the opposite direction. So if you look here, do we see any bull breakout gaps? No. But bears have open gaps. So it's probably a tight channel for the bears. So enter in the always in direction. So you end up here, you know you have to take a short, then you look for techniques to take short entries.
Right. Okay, perfect. And the last short here, bar 42. Let's go through that one because you talked about that
Right.
option earlier on. So
Okay, cool. So 42, very, very big bear bar. And this is late in a bear channel. It's been going on for about 3-4 hours now. And it is also, if you count from here, 1, 2, 3, 4, 5, fifth bar down from that swing point. So fifth bar down from this swing point and late in the bear channel. Those are both two late things happening for the bears. And if you consider somebody who had sold up there and they suddenly get 42 as a big bear bar, totally unexpected, well, what do you think they will do? Probably take profits, right?
Right.
Now look at the 45-minute chart. What is the duration of the legs bears have been producing here? 3 or 4 bars here, 3 or 4 bars here. This is a late bar. So market usually tends to gravitate to produce the same kinds of structures that it has been producing up to now, which I call market tempo. So if it is producing 4 bar bear legs on the 45-minute chart, the next one is probably going to be somewhere in that neighborhood, 3 or 4 bars. And this is the 5th bar, so it's late in that cycle too. A late breakout usually fails. The failure rate for late breakouts is actually very high. It's more than 80%. So 42, as great and strong as it looks, is probably a sell climax and not going to attract too many sellers. So 42 is one of those bars that you either take it as an exit to maximize the profits that you have, or if you're flat and looking, just no touch. Not short, not long, none of them. But if you're a very advanced trader, and if you have a large account and able to scale in multiple times, those traders looked at bars like 42 to actually buy. But that is a very advanced stage. I don't recommend it for almost anyone.
Right. And you said something interesting. You said, so that was on bar 42. And earlier you talked about bar, the transition through the moving average on bar 49. Mm-hmm. And you talked about how we went always in long already on 46. So I want to talk about that for a second. That 46 is a breakout bar. It's in blue. And the reason that 45 is not blue is because 46 meets other requirements in terms of like bar range. So that's why 46 is considered the breakout here. But can you talk about how this would fit into the binary decision flowchart in terms of a minor reversal that could be seen as a minor reversal, but is actually major?
Right. So if you look at the leg down that we have here, all through this sell-off down to bar 42, bulls have been buying. Now look what happened to the bulls. So limit order bulls, they buy below the last swing point, 13, scaling lower, gap closed. Buy below here, gap closed. Buy below this bull bar, gap closed. Buy below this doji or this bull bar, this swing point here, gap closed. Buy below here, gap closed. So when that is going on, the leg that you're seeing that's constantly being sold off is actually a leg in a trading range. And legs in trading range is reverse. Now on higher time frame, we have 3 legs down, sell off here, sell off here, sell off here. And you're seeing the details of the last sell-off, which is bears cannot maintain open bear breakout gaps. So we know the leg down is a leg in a trading range with a sell climax. And you can summarize all of this as sort of like three major moves. One from high of the day to here. Second one, all of that sell-off to here. We have a big pullback here that separates the two. And then one big sell-off down to 43 low. And all of them are variants of wedges. So this entire thing is really a nested wedge. Especially the last leg is very clear, 3 pushes down. So the entire thing needs a correction. And if it is starting to correct, then by the time you see the very first few bull bars, the market is always in long already because of the context, not because of price being above the moving average. If this higher time frame is starting to correct, and you see the correction making sense on this chart as well, there's proper structure and everything is in place, then you don't need the price to be above the moving average to conclude it's always in long. It's probably even always in long during the formation of 42 as the market's going down. There are traders who would look at these higher time frame charts and they bet that the bear breakout is not going to be successful and they start buying.
Right.
Now, I'm not saying that people should do that, but once you see the strong bull bars appearing, even though they are still below the moving average, if you can analyze the context and the context is supportive of the bull case, that is usually an indication that we are always in long, even though the price is still below the moving average.
Okay, so that was a lot of fun. It went a lot longer than we initially thought. Pleasure for me. I'm not sure it took a lot of Ali's time, so I apologize.
I had fun too.
Yeah, it was just such a fun time going through charts, getting Ali's perspective. Really appreciate all the mentorship, all the guidance.
My pleasure.
Agreeing to do this interview. It's just been so helpful. I was trying to ask questions for other people, but then selfishly asking my own questions too for myself. Yeah, such a pleasure. So if you want to just end this off with some final words on TWM, Ali's new program coming out, just share a few more details, final words, anything you want to say?
Sure. So when I was learning all this stuff and developing as a trader, I really wanted to have this opportunity. And I asked Dr. Brooks several times that if you're open to it, I'm going to come to your home office and just be sitting there very quietly to see what you're doing. And he was not comfortable doing that, so he said no. And there were other traders who I asked them, and the answer was exactly the same. And I understand that, in our house, we have a rule that if I'm in my home office and the door is shut, nobody will come there and knock on the door. The only time they're allowed to come to my room is when there's an emergency going on. So that's the rule. I want to be in my trading room, free and clear, and just focus on what I'm doing. So I thought everybody's like that. So there's probably no good trader that will let you to come into their home office and share the time with them. And that's actually an incentive for TWM, because I want to bring you into my trading room and show you what I'm doing, but I want to do it in a structured way, because if I mix everything together, it would be completely useless. You wouldn't learn anything from that, because you wouldn't know why I sold in a bull trend or bought in a bear trend. That's something I quite frequently do. But if I do it in a structured way by telling you exactly what to expect today, and you have a training before you come to the trading room, then that trading room is going to be effective. And this is what absorbed a lot of our time to think about, how can we maximize the benefit for people who want to attend, to not waste their time and deliver something that's actually actionable and usable. So the structure is not a super long program, but it's going to be 10 modules. So the involvement is going to be 10 months. And every month we're going to focus on one of those basic fundamental principles of market behavior and try to demonstrate how to trade one of them. And it doesn't mean that you have to trade every single one of them, but it's going to give you at least 10 good options to focus your energy on one or two or three of them that are the best fit for the trader that you are. So your responsibility, if you choose to participate in Trade with me, is to be diligent and obviously go through the program the best that you can. But towards the end of it, you also have to decide, based on this experience, what are the 1 to 3 really good trading strategies that you have learned that is close to your heart and it's a good fit for you. And then you're going to focus your energies on just getting really good in doing those 1 to 3 things and just ignoring everything else. Because for a developing trader, it's very difficult to mix all of these things together and try to trade discretionarily like an expert. But if you just focus on a few things with all the resources that we're going to be giving you, and you'll have videos and examples of live trading and everything, it's going to help you along the way, I guess, quite a lot, and provide you with examples and resources to come back to. But your job is to focus on the few things that's going to work for you as a trader and use that to build a foundation for your account, start to grow your account. And then once you're more experienced, then you're free to go back and you're going to have the resources. So it's always there for you. You can go back and say, all right, so now I want to add the 4th strategy to my repertoire of things that I'm doing. I'm going to pick this one. And you have the examples and the documentation for it as well. And then you can expand on what you have learned. But initially, you just have to focus on a few things. And we're going to give you a lot of examples of good things that are all going to work. And you have the option to choose 1 or 2 that's the best ones for you. The final thing that I want to emphasize here is that in the Trade With Me program, you're going to be seeing my screen. So it's not going to be something off camera or anything. I'm just going to share my screen and do my own trading, as I do every day. And you're going to be seeing everything, where the order went, how did it get filled, what are the prices, how many contracts, everything. It's like you're in the same room with me and you're looking at my screen. And I'm going to try to explain as much as I can as the trade is going on. But we also have our coaches there to explain the things that I might miss, because my focus is on trading. And it's good to have somebody else whose focus is on the market and market behavior, and they can fill in the gaps for me, because I can't be talking all the time. And then you also have the opportunity to ask questions. But the important thing that I want to emphasize is that you're going to be seeing my screen, how I place the orders, what I do, everything, just like you are in the same room with me.
The first link in the description is going to be for TWM, Trade With Me, where you'll be able to join the program to get the education around the first principles of market behavior, and also watch Ali trade live once a month and get the full educational experience. The second link will be for quantsystems.ca, where you can join Ali's other professional programs like Pro Trader Mentoring and Systems Academy.
Thank you, Faisal.
Thanks, Ali. It was a pleasure. I really appreciate your time.